A bike during lockdown was sort of a difficult feat.
They were a hot commodity.
Just about managed it. Anyway, European equity markets are about to open. Don't expect any fireworks at the get-go. Maybe we get some towards the back end of the week. Keep an eye on what's happening with Reckitt. I think that's going to be interesting as well. We already know that ASMI looks like it's going to be a little soft as well. But the early calls indicate another exciting open here in Europe. Here we go.
That's it.
We are a drum. That was a drum roll. We are now open. Let the fireworks begin, or not. So what are we seeing in terms of single stories here? What are we watching it like? Because index level, nothing.
Yeah.
Okay. Keep an eye on the bond market. We're kind of building up to what is happening with the inflation data, and that story is going to be interesting. But equities look like they're fairly becalmed today. But I am watching Reckitt. I am watching ASMI. I think those are going to be two really interesting stories.
Yeah, both of those could be underperformers, couldn't they, given the numbers that they put out?
They absolutely can. One of your immediate big index contributors here is going to be Vodafone. I'm assuming that's coming off of the Swisscom, their Italian operations deal that's coming. So big bump there right at the open, higher by about 2.3%.
ASMI down by 6%.
Yes, and that technology sector is the worst performing sector across Europe, down by 0.9%, which on a day where not much is doing anything, that is a big move. And a lot of that is ASM International weighing on the rest of the sector. So certainly that chip, that nervousness about the outlook coming through from ASM International.
Taylor Wimpey's down as well by nearly 4%, so we are seeing some softening there. Campari actually soft as well this morning, down by 3.1%.
I suppose it rose a lot yesterday, didn't it, on the back of the of those numbers? So
I blame actually your distaste for Aperol spritzes.
Do you think that's what it was?
For this move.
The market found out that Critty and I were not on board. But you see, the CEO would tell us that's a growth opportunity because we are not yet convinced.
Yeah. You're not beer drinkers, though, so that's kind of where the transition is happening.
I know. I feel like we just need a alcohol tasting of all. Maybe we'll do that on the show one day.
I like that idea. Well, after the show, probably better.
Okay, but let's being mindful of all necessary Ofcom regulations, of course.
Fair enough, of course. We'll talk about one of the other big movers this morning. Alcon higher by about 4% this morning. It's confusing why this is, though, because some of the earnings came out, well, actually yesterday as well. The EPS did beat, so you did have a pretty solid reaction, but this is a pretty big move just in response to the EPS beat.
Okay, let's put in focus some of the stuff that we've gone out of the UK, shall we? Because we've got plenty of earnings reports coming through. Let's start with Aston Martin. Our colleague Sam Unstead joins us from the Markets Today blog to take us through some of these UK stories. Sam, good morning to you. Let's start with Aston Martin. We will put the share price on the screen. This is a business where I think the focus was on, well, succession and also debt refinancing. All of that very newsworthy. But what stood out to you?
Yeah, I mean, so I think, succession is part of the story. That's kind of rumbling on in the background. The really, really key thing for Aston Martin is the refinancing. You know, once they can get themselves onto a more solid footing in terms of their debt position, that will kind of improve things. And the thing to mention also with Aston Martin, because of their debt position and because that's so in focus, their shares can be extremely volatile.
Because they were bailed out by a Canadian billionaire just around the pandemic, and that wasn't a great time.
Yeah, that's correct, and so sales of the cars got a little bit better towards the end of last year. That was kind of expected, but really the key thing is about the refinancing and when they're going to get that done.
Let's talk about houses and how we clean them. Let's start off with Taylor Wimpey. Why is Taylor Wimpey soft this morning?
Taylor Wimpey really, overall, their results, I would say, look broadly in line with the other house builders. But one thing that they mention much more so, and this is interesting because on Monday we had the CMA report, and much of that CMA report focused on how broken the planning system is. There's a lot in Taylor Wimpey's statement today about the planning system and about how difficult that is making it to increase supply of houses. And they actually go through it quite significantly in there.
Has the CMA given the house builders an excuse? Again, the planning story is so... Like, it's been around for such a long time, but you do wonder whether now this is something almost the house builders can hide behind.
Yeah, I think that's actually quite right, because actually, generally, they do mention these things, obviously, when they release results. Yeah. But there is a pretty significant section devoted to this in the Taylor Wimpey report this morning, and going through, areas that they think might help, but lots of areas of the planning system, the changes that are being made that they think will actually make things even worse.
That could be worth reading, though, that detail around planning, because Jenny Daly, who's the CEO of this business, she actually comes from a planning background, which isn't entirely usual in the house building sector. Many people come from construction or finance or other places, but so to come with that planning expertise, she certainly brings a lot of experience in that on that sector. So we'll certainly focus on that. Now, Guy said houses and how we clean them, which I guess means Critty, you're going to ask the Reckitt Benckiser question.
I might as well. Your thoughts
on cleaning or Reckitt?
I think it's worth.
I'm going to let you make that judgment call.
I think it's worth mentioning with Reckitt, right? That going into these results, they were kind of expected to be a lot weaker because of very difficult comparables from the previous year. So we had a very severe cold and flu season, so their health business did very well last year. And then the main thing was that the infant nutrition business in the US had this huge shortage last year, and they saw a massive spike in sales because of that. Those two things have fed into the results being a bit weaker, but they are even weaker than had been anticipated. And a lot of this is, again, for most consumer stocks, inflation is cooling, their pricing power has gone down, and so the results are looking a lot weaker. And actually, their CEO himself in their statement said their fourth quarter results were unsatisfactory.
More putzing required. I'm actually looking for a price on St James's Place this morning. Still don't see one, so we'll see when that opens. Pre-tax loss, 8 million.
Yeah, and actually, the really significant part with St James's Place, so their shares, they're down by about half over the past 12 months. Yeah. This fee review that happened in the middle of last year really hit their shares, but in particular, it's hit their cash. So their cash flow has been hit, and that's meant their dividend for the final part of the year is only going to be 8 pence, and it was expected to be closer to 37 pence.
Ouch.
So likely to be a pretty big hit for them too.
Okay, and when we talked Reckitt, we couldn't get an opening price on that either because it was not open. It is now open. It's down by 8.5%. At this stage, 8.3% at this stage of trade.
St James's Place is now open as well. Perfect timing on everything. That stock looks like, hang on, let me find, I've actually got to move my paperwork, figure out, because it's dropping so much on the screen. It's down by 21%.
Wow, okay, we'll keep those in focus. Sam Alsted, thank you very much from our Markets Today blog. You can get much more on the UK markets. You go to the Bloomberg UK website or type TLIV Go on the Bloomberg terminal. That'll take you to the Markets Today blog. Away from some of those UK movers, though, let's get some of the movers that are in focus for Joe Easton this morning. Joe.
So we're actually just going to quickly have a look at Reckitt because it's just open now, down 8%, a huge move for that maker of household goods. And we are seeing a bit of read across over in the sector as well. We've got Unilever slipping a bit, Haleon, the business spun out of GSK, and Henkel as well in Germany. These stocks coming down slightly, but the big surprise is that drop in Reckitt with that miss on like-for-like sales. Then in terms of the European earnings we're going to look at, we've got a few from stocks to watch as well, starting with ASMI, another weak one. The company not giving specific guidance for the year ahead, spooking investors, suggesting that there could be downgrades to come in the chip machinery space. And Lanxess over in Germany, this is in chemicals, another weak one from them, a very cyclical business, and yet again, that potentially meaning downgrades. So that one falling 4% on the DAX index. We had Auto One. This is classified as a bit of an auto trader rival. That one was looking about 10% higher on the Tradegate exchange, but only up around 1% now. And Worldline, yet more negativity for the payments processing firm out of France, a bunch of downgrades for them last year, and that one coming down, a 9% fall for that one today, following yet more downgrades for them in their earnings report today. In terms of the deals, we'll take a quick look at Vodafone. This one was edging higher in the pre-market. There it is, up 2% at the moment. The deal talks with Swisscom about the Italian business look to be progressing. 8 billion euros that deal could be worth, and as such, some minor negativity in Swisscom at the moment. In the drug space, though, Idorsia, take a look at this one over in Zurich, up 25%. The pharmaceutical company is doing a deal with a rival over there that will see them get around $350 million worth of upfront payments from licensing out one of their drugs. So that's the biggest gainer we'll get all day today for sure. And Segro actually higher at the moment. They've done a massive share placing announced after the close of trading today. This is UK real estate. £800 million they are raising. That was at a discount. So I'm surprised to see that stock ticking higher at the moment. As I say, that is a bit of a dilution for them. Then I think we've just got one morning call to bring you. We're going into UK Insurance Direct Line, downgraded at Citi, who says that the company could be set to write down hundreds of millions of pounds worth of earnings at the report next month due to weakness in the motor and home insurance market. So that one is coming down 2%. That's Direct Line in London.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of these pretty big moves that we are seeing. On the index level, not a lot to digest, but the nitty-gritty is where it's coming at. Coming up on the program, we're going to talk about listings in London. This is becoming a really big topic, especially off the back of Shein eyeing the FTSE. Despite a string of IPO stumbles, it's just the first after several companies really kind of saying no to London, yes to New York. How does London get back on its feet? Take a listen to what one analyst had to say.
For Shein, I think it's quite interesting. If the reason for them not wanting to list in the U.S. is regulatory burden, then I would question how deep the pool of capital that they can access within the European markets can be, given that European regulators have even more stringent regulations when considering ESG standards in the fashion industry, which of course the homegrown industry has learned to live with. But for someone like Shein offering rock bottom prices with perhaps not as much transparency on its supply chain, it'll be an interesting point to see where exactly they can derive that improvement.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
liquidity pool that Euronext has created accommodates aggregate market capitalizations of approximately 6.3 trillion euro. It's about twice the size of the London Stock Exchange. It's at about 3 times the size of Frankfurt Exchange. The average daily volume we trade on the Euronext single market is approximately 10 billion euro. It's approximately 3 times the size of the equity volumes traded in London.
All right, your next CEO there, Stéphane Bougenin, speaking to me back in November about just the kind of lack of liquidity you're perhaps seeing in London relative to the Euronext guide. This is something that we're talking a lot about, whether or not London can actually come back. When you're starting to see this real hesitation, not just in terms of IPOs, but in terms of actually trading the products once they get there.
Where does the catalyst come from broadly across Europe? What do we need to do to get this market moving? How do we close the valuation gap with the United States? There's a lot of debate about this at the moment. There doesn't seem to be many answers. Clearly, Europe is debating its regulatory framework. Do we need a single market? How does that happen? Are trading hours too long? The list goes on and on and on. We talk about stamp duty as well. Maybe we'll do that in just a moment. One catalyst, maybe, is that we can re-engage with retail investors. One catalyst that may help that is that apparently the UK government has opened talks with brokers. We're talking about Hargreaves Lansdown, AJ Bell, about maybe those brokers helping to start the process to sell the government's NatWest shares, which, remember, it took over when it was Bank of Scotland back in the financial crisis. It's been a long time coming. We've been anticipating this. Does it re-engage retail? Is this a catalyst for the London market? Bloomberg finance reporter Will Shaw joins us now. Will, walk us through the details. What do we know?
So basically, there's a lot of expectation that during the budget on March the 6th, Jeremy Hunt will announce that, yes, this sale is going ahead. If that doesn't happen, people are going to be surprised. Like you mentioned, talks have opened with brokers, including AJ Bell and Hargreaves Lansdown. They've been asked to sign non-disclosure agreements. The talks, we understand, are at an early stage. Also, M&C Saatchi, one of the titans of British advertising during the 1980s, has been recruited to help sell this to the general public.
Okay, that'll be one to watch, won't it? Well, you know, we remember well, some of us remember the sales of the 80s, and just putting myself in that box.
About me here.
Yeah, we remember the sales of the 80s, and of course the marketing lived on long after those capital market activities took place. I suppose one of the struggles here, Will, is if you want to buy NatWest shares, you can go to the market and buy NatWest shares right now. You don't necessarily have to wait for an IPO, so that puts pressure on them to price this right. What else are we watching?
So yeah, you're right. It's a big conceptual challenge in that, like you say, during the 1980s, during the Tell Sid campaign, that would have been your first chance to own something like British Gas. Whereas today, you can go out any time you like, you or I, as a retail investor, and buy these shares. So what is the pitch? Like, we just don't know from the government. There are a number of other problems potentially around this. For example, it's likely to happen into the run-up to the general election. That means if it doesn't go well, it risks kicking a bit of a hole in the Conservative Party, just as they're trying to ask the government for ask the general public for another mandate. Also, the government's going to be worried, is this just going to be something that wealthy people in the southeast buy into? Like, how do we pitch this to the whole of the general public? The stakes generally are high. This is the government has owned NatWest since the 2008 financial crisis. The Tell Sid campaigns in the 1980s were a pivotal moment of the Thatcher era. If this goes right, there's a lot of potential upside for the government. If it doesn't go right, there's a lot of risk.
Okay, well, thanks very much, Bloomberg's Will Shaw covering NatWest for us. Thank you very much for the update. Joining us now to continue this conversation about the London market, essentially, and how we reignite some animal spirits, how London fights back. Ewan Munro, CEO of Newton Investment Management, is with us. Of course, Newton, owned by BNY Mellon. Very nice to have you with us, Ewan. Thank you for joining us. So is this the kind of event that we can look to try and reignite those animal spirits in London that do seem to have been lacking of late?
Well, certainly anything to engage investors with the London market has got to be a good thing. I mean, NatWest, though, is one of the typical UK stocks, you know, a mature business, dividend paying. It's not the exciting growth stocks that have been attracting attention in North America. And so to some extent, it's more of the same. But certainly there's going to be a big marketing campaign and a big story that hopefully will re-engage people with the concept of investing as opposing to saving and just sticking their money in the bank.
Perhaps we'll talk about a lack of tech stocks or a lack of exciting growth names in London in a moment. But what about London's ability to put the right value on the things it has? Do you think that London has a real problem on that? Some people suggesting that the London market just isn't valuing things correctly, and that's why there is so much interest from private equity and elsewhere.
Yeah, I mean, London is clearly a value market at the minute, so we have the private equity actors in looking to take some of these undeniably cheap companies private, maybe add a bit of leverage and make a turn. And so that is actual value, that's support underneath the market, which means I think it's a very safe market to deploy capital in, but it's just not exciting. And so I think the London market, it did well in 2022 when the market was in a downturn. And I think the real excitement about the UK probably awaits some of the shine coming off the high growth sectors.
But how do you expand the liquidity pool at the end of the day? Because you're talking about the outperformance in 2022. That's because everyone pulled out of the market, and therefore that tinier pool looked more attractive. How does, say, someone at the LSE say, we need to tackle this liquidity story?
I think they might need to do more international outreach work. I think, global portfolios around the world will allocate capital where they think they're going to get the best possible return. And for a long time, UK pension plans were the backbone owners of UK equity, and we've seen a massive shift as they moved to liability hedging strategies and so on and moved out of the UK. Newton, for example, we have less than 5% of our asset base. We're much more in the US than half in the US, 5% in the UK in terms of our allocation to markets, and that's client choices. So I think we need to get. The UK was in the doldrums because of a lot of political uncertainty around Brexit and so on. I think the politics are going to play out elsewhere over the next little while. If we do have a Labour government coming in, it's likely to be quite a middle-of-the-road Labour government. I think Keir Starmer's not wanting to rock the boat too much, a lot of overtures to the city. So there's going to be relatively little substantive change politically in the UK, and we could be an island of calm. So I think getting out with that story, saying we're cheap, we've got some political stability, it's maybe time to start deploying capital to the UK.
You use that key phrase, international outreach, and we've talked about this in the context in the last 24 hours of the perhaps Sheen coming to London, but that comes with a lot of controversy in terms of whether or not that international outreach then creates some sort of concerns around regulation, of course the geopolitics, correct accounting measures, not to mention some of the concerns about how it's going to be received by American investors in Europe. Should London just bypass all of that and really just embrace that kind of identity of portal to the rest of the world?
Yeah, well, I think London is a very international market, so I think anybody that buys into the UK equity market should understand they're not buying the UK economy, they're buying into a very global market, and I think that's to be celebrated. When I talk about international outreach, I suppose I'm talking about two things. I'm talking about encouraging international investors to buy existing UK stocks and elevate the share price. But I'm also talking about attracting capital to list here, and that's the Sheen story. I wouldn't like to think that we would attract capital by having lower standards on governance and so on than anywhere else. I don't think that's typical of the UK. I think we have very high standards, and so I don't think dropping the standards is the right way to do it. But being a great venue for attracting international capital, yes, if we can make that case, that would be attractive.
When you were coming on, I knew you were coming on, I kind of wrote down a list of all the things that potentially could change, that maybe we need to think about across Europe. Too many exchanges, stamp duty. We've got a sort of total return branding problem. The index isn't going up, but the total return actually looks better once you factor it in. You've got long trading hours. There's a liquidity issue around kind of the trading hours as well. How much of this is an easy fix, do you think, that Europe can... Are there some simple levers that we could pull to maybe make these exchanges, not only here in London, but across Europe, more attractive? Stamp duty looks like an area that a lot of people believe is a no-brainer here in London. Get rid of stamp duty, makes it easier to trade. Maybe you solve some of the liquidity problems as well. What can the next government do?
Yeah, I certainly think they should look at stamp duty. I think anything that gets in the way of any friction in the process is not helpful. I think one of the reasons why the US is able to attract so much capital to growth is that there is massive retail engagement in investing. A lot of institutional investors have got liabilities to concern themselves with. Actually, the dividend relatively mature businesses in the UK are quite attractive if you've got long-term liabilities to meet. If you're a retail investor trying to make some money relatively quickly, then access...
But income's really important. We misjudge European markets. We misjudge the UK market.
We do.
Because to your point, it's an income story.
Yeah.
Pretty every morning has a conversation about dividends. This is a market that throws off lots of dividends. You can look at the index return, you can look at the share price returns, but you need to factor in the total return calculation.
Absolutely. I'd love people to talk more about total return. I'd love people to talk more about return per unit risk as well, because clearly the best returning things usually come with a much higher degree of risk. But that immediacy of being able to trade on various platforms in the US at very low fee levels, that does pull in the retail investors and provides that layer of liquidity that we don't seem to have in the UK. And I think yes, stamp duty may be a problem that needs to be addressed.
Very quickly, now that the Euronext and some of these European exchanges have a consolidated tape, how much of a headwind is that for London?
Sorry, I missed the...
all good. A consolidated tape. This is something that Christine Lagarde had pushed for very aggressively for the European exchanges. Does that create an additional problem for London?
I don't think it necessarily does. I think London's main problem is just if investors are excited about coming to London, they'll find a way to access the securities. So I don't think it's a major issue.
Okay, Ewan, thanks very much. Thanks for joining us. Ewan Munro, the CEO of Newton Investment Management. We thank you very much for joining us. We've had some news coming out from von der Leyen, haven't we? Perhaps somebody else has it closer to hand.
Yes, we have. He's actually come out, or she's actually, excuse me, come out and talked a little bit about the defense story in Ukraine. We know this has been a concern about how you actually amp up your armed forces. She's actually coming out and making a speech here and saying that in keeping with what Bloomberg had reported yesterday, by the way, that there was a draft proposal. The EU ultimately wants to be autonomous in defense, reduce dependencies. China was not named, but it seems to be the illusion that was
it's China and Russia. She's a former defense minister as well. You've got to remember that, out of Germany. And it's this idea that post-Trump, maybe Europe needs to disengage or needs to find its own way, increasing spending. The question then comes, how do you do that?
Yeah. So
and how do you fund that?
So, yes, exactly. So producing its own ammunition has been a conversation that's been rumbling for some time. How you fund it, how you make sure that private capital can find its way into this sector in a way that doesn't.
And how, do we do joint issuance? Is that something that we could consider in terms of a program? No, but it'll be. Everybody was on different pages going into the pandemic as well. Ultimately, we ended up on the same page. Could we end up on the same page here again, particularly if we do get a Trump presidency?
Not to mention windfall profits, frozen resident assets. Where does all that money ultimately go? Does it go back into funding things for Ukraine?
Okay, so that's the story around European defence. We were just bringing you some live pictures of Ursula von der Leyen speaking there in Strasbourg, I believe. Coming up on the programme, we take a look at what's on the agenda at International Energy Week. It takes place in London this week, of course, so many from across the world gathering in London to talk about energy markets of all kinds. Oil, gas in focus this morning. We'll get some analysis coming up from Trafigura. In fact, this is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're about 30 minutes into the European trading day. Seeing a little bit of a down note on the stock 600, down by 0.1%. But again, nothing to write home about. Guy has been saying this. Anna has been saying this. It's a big nothing burger on the index level. But you are seeing a lot of moves on the corporate level where you are starting to see housing in particular take a pretty big hit this morning, Anna.
Yeah, absolutely. Real estate, the second worst performing sector this morning. In terms of sectors on the downside, we've got personal consumer, discretionary, grocery stores, the worst performing. And the worst performing stock within that is Reckitt Benckiser, the maker of all kinds of household products. That stock down 9.8% on the back of that miss around like-for-like sales. So the big picture is stocks going not very far, as you mentioned, Crady. A bit of downside here in London, down by around 0.25%. And in terms of the sector picture, we're sort of half and half, gainers and losers, Guy.
St James's Place under significant pressure as a result of what we're seeing with the dividend story. That has been a stock that's been coming down and down and down and down. Today taking an absolutely massive hit in London. Talking of London, London is hosting International Energy Week. It's nice to get everybody together. The sector's key players discussing, well, geopolitical tensions, what's happening with the energy transition. Oil under a little bit of pressure today, but the mood overall starting to feel a little bit more buoyant. The US economy looks like it's on a tear right now. Who'd have thought the rates would be where they were at the start of this year? I think everybody was expecting significantly more cuts. Let's get a take now from Trafigura's chief economist, Saad Rahim, joins us. Nice to see you.
Thank you. Thank you for having me.
At the beginning of the year, we came in, we thought rates were going to be cut, we thought demand was going to be an issue. That's been completely turned on its head. How much do we need to upgrade our demand expectations with a US economy that's on a tear? Maybe we start to see China bouncing back. What's the picture?
No, I think you're right. I think the fact that rates are closer to 5% than they are to 3% sort of tells you everything that you need to know about this market right now, is that people are upgrading their growth forecasts. And in particular in demand, I think that's really been the key theme from the first few days of this week here at IE Week this year, is that, people came into the year expecting a very balanced market, 1.1 million barrels a day of demand growth, so about half of what we got last year, and about 1.1 million barrels a day of non-OPEC supply. So that sort of suggested that OPEC would need to keep the cuts in place for a long time. But now you're starting to see demand revisions upwards, and people saying, you're hearing the phrase upside risk a lot more than you have in the past couple of years. And again, even for last year, I think the key story was really always demand fears, growth angst, and one of the best indicators, at least of where oil prices were going, was the 2-10 spread, because that was people's proxy for recession risk. As we started to move away from that, as you say, the U.S. economy looks like it's still very much on fire, despite 525 basis points of hikes. We're looking at a very different picture, I think, for the rest of the year.
So why has oil struggled to get through 80? And what kind of a range should we be thinking about? Give us your price take on where you think we go?
We can look at what's really happening on the physical market indicators, right? If we look at the front month spread, the difference between this month and next month, we were looking at a pretty significant backwardation, meaning people are willing to pay up for oil today, partly because of what's happening with the disruptions, the Red Seas, crude taking a lot longer, product taking a lot longer to go around. But I think really we're saying if we look at that, that's telling you that this market does feel relatively tight. And you can look at a number of other physical market indicators, strength in Asia, strength in the U.S., but even some real strength in Europe as well. So the fact that, what we call flat price or Brent really hasn't moved, to the higher, or WTI hasn't really moved through 80, I think a lot of that is financial markets, financial players, macro players still looking at this saying, do we really buy into this demand story that at least a physical market is telling us? And there are other headwinds as well, right? What is happening with rates, a stronger dollar than I think people thought about coming into the year, and that's being a real headwind as well.
Okay, good morning, Saad. So if this does have upside risk potential, does some of that come from China? Is that where the demand story is focused for you? What are you seeing in China? What changes?
Well, I think China tends to be really one of the key players on the demand front. I think this year likely no exception, as we continue to see a rebound in air travel, in personal travel as well. Really the key question globally, though, is what's happening with the manufacturing sector. Manufacturing really has been in a recession since the Ukraine invasion, but do we start to see some signs of life, coming back in that? Certainly in the U.S., again, we're seeing a very strong jump in ISM new orders, things like that. That's telling you that maybe we're starting to see a little bit of recovery there. Same thing on petchems, right, which are obviously going into manufactured goods. That's starting to see a little bit of a rebound, at least in some of what we're seeing in China. Now, but I think this is not just the China story this year. I think it is other areas that are looking to perform as well. India oil demand growth in January, very strong, 8.6% year on year. That's now the third largest consumer of oil in the world. So if they're operating at those kinds of numbers, this is telling you this is not just sort of a one-story market.
So that's the signals you're reading from China. What about Saudi and the supply side there? Saudi's decision to not increase their maximum sustainable capacity. Some people interpreted this as their take on demand and a weak signal around demand. Others saying, actually, no, it's just Saudi wanting to do other things with some of that money around their vision plans. What signals do you see coming from Saudi?
Well, I think that's right. I think they have a number of very large projects that they're doing, whether we look at NEOM, whether we look at what they're actually doing also in the mining sector, the metal sector, batteries as well. They're really investing in a lot of different sectors. So I think allocating some of that capital into there, I think for them makes sense. But I also think it's saying, look, we have the reserves. We can always decide in a few years if demand looks like it is going to hold up to bring in some of that capacity. But right now, we're saying we want to reallocate that capital elsewhere. I didn't read it as this is a take on long-term demand being lower. I think it's just saying we want to be prudent with where we allocate.
Let's continue our tour around the world, bring it right back to the States. If we're talking about what the next 12 months looks like in terms of supply coming out of the United States in a election year as well. How are you thinking about the geopolitics around it, specifically under a potential Trump presidency or even a Nikki Haley presidency? Basically, if Joe Biden's not in the White House, what does oil supply look like out of the U.S.?
Honestly, I don't think it really matters that much who is in the White House, because really production plans and what we've been seeing, rig deployment, capital invested in the sector, has really been driven by the market, right? So shareholders saying, actually, we want you to prioritize buybacks and dividends over new capital investment. I want dollars, not barrels, right? And if that's the case, then it's not really a question of who's in the White House. There may be more impact on the demand side, depending on some of the policies that would come in maybe under a different administration. And that's something that we would have to watch. But I think on the supply side, it's really producers are going to invest at kind of the rates that they think make sense for them.
But the shale companies have been noticeably at odds with President Biden for a variety of reasons, especially when it comes to kind of diversifying into LNG, et cetera. Things like the LNG ban, things like not being able to get licenses on federal ground that has that oil access. Does that really have that limited of an impact?
Well, look, I think these are different things, right? So I think on the LNG side, I think that if that continues, that goes forward, that's probably a fairly large impact. I think the drilling on federal lands, I think if you talk to the companies, they are holding quite a bit of acreage already. So it's not that there's huge swathes of land that they're saying, well, we're being blocked from drilling on. I think it really comes back to that capital discipline, sort of the zeal of the newly converted on that, and they've been sticking to it. But now we'll see, can we continue to grow that? But I think overall what we're saying is, most industry observers are saying while we will continue to grow supply out of the U.S., that supply growth is slowing, right? So especially the players who are closest to it on the ground saying, look, we think this starts to step down quite a bit.
Okay, so let's zoom out then. You talked a little bit about upside risk in these oil markets. there is a concern, not a big concern, but a concern in the markets that there's going to be some sort of inflation re-uptick, for lack of a better term, specifically at the end of this year, early 2025. How much of that inflation uptick could be commodity driven? Are we looking into a 2021 repeat?
Well, what's interesting is I think it's less the impact directly on inflation, but more on inflation expectations. Because if you look at it, what drives inflation expectations, in particular in the U.S., it's going to be what's the gasoline price that day, right? And that's a huge indicator for people. It really drives consumer confidence as well. But we saw this in September as well, where I kept saying it's the tail wagging the dog. Whereas as oil prices ran up to $98, which feels like a very long time ago right now, but that was one of the things that actually drove rates higher. Was, again, that expectation was that if people start to think, wait a minute, inflation is actually going back up, re-accelerating, that led to a very different rate outlook. That then has knock-on impacts, as we know, back onto the dollar, back onto growth, onto everything else. So it's not a one-way street that if oil prices do continue to go higher, what actually ends up happening, and there may be a governor on that because of those knock-on impacts.
Well, I think we'll see that showing up maybe in the UMISH data on Friday. It's always that kind of sticker shock of what's happening at the gas pump that has a big impact there. If prices go higher, though, will OPEC keep a cap on those prices moving higher? There must be some desire within OPEC to put further product back onto the market. So if prices come up, does that allow Saudi, does that allow others maybe to pump a little bit more?
I think if it's coming from a demand side response, I think then potentially they could start to discuss that. June, which is their next meeting, the next time they would adjust really production, I think maybe that's a little bit early for them to do that. But, if you're saying, well, demand growth is now, instead of the 1.1 that people were expecting, maybe it is 1.7 or 1.8, if it is something like that, if it's like that. And that's why prices have moved higher rather than just a supply side response, which may be temporary. You don't want to bring barrels back in too early if it's just a supply side issue, right? But if it's a demand and it looks like it's actually holding up and it's structural, then you can start to think about adding some of those barrels back in.
So we've talked about demand and supply on many different fronts. Thinking about one of the mechanisms that operates in this market right now, it concerns Russian oil and the price cap put on Russian oil. Colleagues tell me that there's been some real effort to tighten enforcement on that. I wonder if you think that's material. I wonder if you think that has an impact, and also whether there are conversations happening, this is IE week, about with whether that $60 level will be dropped. Where's the conversation on that?
Well, look, I think that's an ongoing conversation. I think the U.S. stance on this has been fairly clear, which is they've said we want redirection, not reduction of barrels, right? So it's really about, we're not going into it's the previous markets. They are tightening enforcement around some of the, especially some of the shipping side of things. But so far, we've not seen, I would say, a material drop in Russian exports. I think that's one of the stories that caught the market off guard last year, was that Russian flows did continue to remain high.
And that was by design, and you don't see a change in that?
Well, I think you are seeing a little bit of a reduction. If this does continue and they continue to tighten the sanctions, then maybe we will see that. But really, then it becomes a question of who's going to step in as a marginal buyer, right? So India, in particular, for example, has been taking a lot of Russian crude. They're now saying maybe with some of these changes, maybe we'll have to step back a little bit. Do they then need to look elsewhere for those barrels? Does that lead to a tighter market? And then what is the Russian response?
Did you watch the Wigan game last night, Bolton?
I did. Yes.
You did?
A little bit, highlights, yeah. So
they're showing it at IE week, maybe.
Yeah.
Well, the reason is Ben Lovecock is now, looks like he's a backer. So I'm just wondering if there's going to be a kind of Wigan-style show at Bolton, that Ben's going to become some sort of rock star. That's what we're all looking for.
And stop us if we're testing your knowledge.
No, absolutely. No, we're all part of that.
You're all on board with the Bolton story. I love it.
Absolutely. It's a real turnaround for us. It's a really big thing for the community there. So we've gone up there for a few games, and you really look at it, how important it is to that fan base, to come back from the absolute bottom to where we are today, and hopefully looking good.
It's almost like it's got a Netflix series.
Yeah, well, precisely. Exactly.
I mean, who knew?
I find the fact that they lost to Wigan last night was kind of the lead into that very nicely. Sard, great to see you. Great. Enjoy the rest of the week. I'm now going to follow Bolton a little bit more closely in terms of the performance. We'll see whether we can magic some up there. Sard Rahim, the chief economist, joining us from Trafigura. You got a busy day busy week coming up on this front, haven't you? Right.
Yeah, absolutely. And today, I'm going to be moderating a conversation about oil markets. We'll pick up on some of the themes that we were just discussing there around OPEC Plus, around the demand story, around China, around India. India's been featuring in quite a lot of our conversations recently around demand, so that'll be interesting, around the geopolitics, never far from these markets. So that conversation a little bit later today. Halima Croft from RBC Capital Markets and others joining us to talk about where we head on oil markets.
Let's talk about what's coming up on this program here. Private credit's code of silence. We look at the hidden flaws in a booming market. Stick with us for today's big take. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Are still very high, and you see the rebound of stock market, especially the tech, the Nasdaq in the US. And central banks care a lot about bubble as well. It's inflation, but inflation is the day-to-day inflation, which is the worst. But also you've got bubbles everywhere. And when stock markets are back up to the roof or private market valuation are very high, central banks are not a strong incentive to decrease rates. So what does that mean for a longer time? Probably it takes another 12 to 24 months to see a different pattern.
TKO Capital co-founder Antoine Flammarion on private credit and this idea that we're continuing to see all of these funds flow into private credit, go away from the public markets, but has it peaked? Of course, private credit funds lending money directly to companies is becoming a must-have for investors seeking stable values, high returns. Apparently, they're all the rage, according to Guy Johnson and his sources. Regulators, though, starting to worry. Reports that fund managers are in the red-hot $1.7 trillion market, regularly valuing their loans more generously than others. It's the topic of our big take today. The author joins us this morning, Bloomberg's Laura Benitez, to walk us through it. Laura, a pleasure to have you on the program. Talk us through the thinking here. Why is this so hot? Why now?
Obviously, the market is booming and it's growing, so there's more questions around
regulations, how the market's being valued, how assets are being valued. What we've been looking at is just exactly that. So in public markets, you have obviously bonds and loans which are traded fairly regularly by traders, brokers, bankers, those who want to buy and sell. So you have very clear, regular pricing. In private markets, it's marked at the fund manager's discretion, usually on a quarterly basis, but not even that. So there's lots of opacity in the market generally.
Sounds like something that regulators are going to absolutely love. That's what we need at a critical moment. We don't know. So when do we start to see this area starting to be more tightly regulated? Regulators are already starting to show an interest in what's happening here. How quickly could that process unfold?
It's a good question. They have started to take a big interest. There's been some engagement. The Bank of England, for example, has warned against assets being opaque and vulnerable to very big shocks in the market. So we are starting to see some engagement, but so far we haven't seen anything that will pose in the near term any significant changes. But as you said, let's see.
What are the risks for investors here then? Because a lot of investors have started to think about, they've got exposure to the listed stuff, and then there's these alternative assets, and that increasingly includes things that aren't listed, aren't traded, lack transparency by design. What are the risks there then, Laura?
I think one of the biggest risks is that investors are not able to make the decisions that they might make if they could actually see the real value of the asset. So, for instance, if they think something's marked at par, they're quite happy to perhaps leave it. If it was marked much lower, and that was a reality, they may change their strategy or reallocate somewhere else. So I think just being in the dark and not being able to make that empowered decision is definitely one of the biggest risks. However, some investors do like this market being very private and very opaque. It means there's no active management. They're perhaps not on the phone to their LPs every day having to explain market volatility. So there are some pros and cons, I'd say.
Are there any kind of red flags that have shown up in your reporting? Anything that really strikes out to you?
So we've looked at two key areas in this story, which one of them is something called PIK, which is when a borrower decides to defer the interest on a bond. The amount of PIK bonds are actually increasing in a lot of these BDCs, which are the private credit portfolios. But worryingly, the marks are not reflecting that. So the marks are still marked very high on these PIK issuances. However, in reality, in the public bond market, they've been marked much lower. Another area we've been looking at is just the very wide discrepancies in the mark. So we've seen assets, the same asset that's held by one manager in the 90s or even at par, and another manager in the 70s or 80s. So very wide discrepancies there that I think spark a lot of questions.
And not a lot of transparency or consistency in what documentation is provided sometimes to those who have to do the valuing, I think was one of the other things coming out in your story.
Yes, that's right. So there are third-party evaluators, and the portfolio marks do get sent out to these evaluators. I mean, these evaluators are paid by the firms themselves. That poses, perhaps some issues, or I think warrants some questions. And only a sample sometimes gets sent to the evaluator, so they're not seeing the full picture.
Okay, Laura, thanks very much. Thanks for joining us. Laura Benitez with the Big Take story this morning. You can find more on that on the Bloomberg terminal, of course, or on the Bloomberg website. Now, we should pivot to what's going on in Paris at the moment, because the heads of major US banks in France say the pool of talent and measures to increase the attractiveness of France have made Paris the new trading hub in continental Europe since Brexit. The Wall Street leaders spoke on a panel with Francine Lacroix in the Bloomberg Paris bureau to promote the new Bloomberg Paris newsletter.
Paris for us is a hub. Clearly, it's our continental Europe hub. We've grown from 250 employees to more than 900 now.
We had 170 people before Brexit. Now we are more than 400, and we have extended the office, opened a second trading floor to be able to cope up to 600 without having to move again.
A lot of things have happened already. And that's why we have 400 people on the ground today, and we will probably continue to grow, but at a different space.
In the end, we will have tripled our headcount in Paris between before and post-Brexit, and we feel that this may go further in the future.
What really made the difference is President Macron, the measure he took to make France more attractive. And also, in my view, what really made the difference more than anything else was the pool of talent.
The mathematics, French school, etc., is actually looked at from everywhere in the world as something that has momentum.
Where I'm the most challenged is it's on the overall labor cost in France.
The labor market is complicated in France. Having more flexibility is something that is important to all of us. And when you grow headcounts in an important way, it becomes more and more important.
We are a cyclical industry, and that we need to be able to be flexible on headcounts.
You need to tell the juniors, the graduates, if you want to have an international career, you can go to London, you can go to New York, but you can also go to Paris, because Paris is becoming much more international now.
Some of the views on what's happening in Paris, or what has happened in Paris. You can subscribe to the new Paris Edition newsletter. You can certainly do so on the Bloomberg website. But here's the problem, and this comes back to the conversation we're having with you. And do you want to go to Paris? Do you want to go to Milan? Do you want to go to Frankfurt? Europe has this patchwork quilt now of markets, of regulations. Europe's struggling to get together in terms of delivering that kind of financial market coherence.
Yeah.
And people talk about the undervaluation of Europe. There's just, there needs to be a greater centre of gravity. Now, where that ultimately ends up being, I don't know.
Yeah, because the issue would always be nobody wants to give it up to the other guy, do they? You know, if you're in charge of building financial markets in Amsterdam, you're not. You know, you're excited for Paris, perhaps, but you don't really want to give it all to Paris. And so creating that European hub remains difficult. And then whilst Europe does that time and time again, the US wins.
Well, you know what's so interesting? All these bankers from, JP Morgan, et cetera, that went to Frankfurt or Paris, they come to London once a month anyway. So it's funny that we're talking about this kind of like, oh, well, London is lost and losing the battle on these listings and liquidity, but people still keep coming right back here. So this kind of narrative of Paris is the next London doesn't fully seem to be true, because Paris is a little bit of London, but they keep coming back, and banks keep paying for them to come back.
Yeah, there's always this conversation about the wider ecosystem in London as well, and for how long that remains relevant. I mean, hundreds of years of the legal system, a lot of asset managers here as well. Although we spoke to a big French asset manager just today, didn't we? So, they're on both sides of the channel.
They are on both sides of the channel. But if Europe needs its capital markets, Europe needs to find a better way of deploying capital. Europe needs to find a better way of getting an investment. You can look at what's happening in the economy right now. One of the biggest factors is that issue of capital allocation.
Well, I think also just something I'm learning, and I'm going to play my American expat card here, is London, and I keep using it as kind of portal to the world. Accessibility from the rest of the world into London is obviously much easier than New York, but it's also much easier than Paris, much easier than Frankfurt if you're coming from India, China, Dubai,
But it's the
Singapore.
challenge actually Dubai rather than all these continental markets, because Dubai is, you go there, it's booming. And a lot of asset managers, a lot of financial professionals are moving to Dubai. And that certainly seems to be there, because if you talk about accessibility, that certainly is an area that is delivering.
In the public and the private markets, right? This week, Goldman talking about that $1 billion allocation towards India, but partnering with the Abu Dhabi Sovereign Wealth Fund.
I am struck by the number of times that India has come up in conversation over the last week or so. When we were talking to Accor, that's in the hotel business, and they were talking about the growth of the Indian consumer. We were listening to, we were talking to Trafigura moments ago, talking about the oil markets, and they were talking about the role of India as a big consumer. I mean, that's not new, but the fact it just keeps cropping up in conversation is quite revealing about where, especially as China faces the difficulties it does, where the growth story is coming from.
But you know where it's not showing up is that when we're talking about these markets and the risk sentiment, what happens in the public markets in India has no read-through anywhere else. And I think that's kind of the next kind of phase that needs to go to.
The Indian market's been on such a tear. And yet the ripple across into other markets has been astounding. I'm surprised we haven't heard more about India. I know we've heard something about it, but actually India, every single conversation I seem to have with the CEO seems to crop up in some shape or form at the moment.
But it's because so much is driven by infrastructure spend, right? That
democracy sometimes take longer to get places.
Famously, apparently. It's not 250 years.
Well, what's that? That's it for markets today. The Pulse is up next. European equity markets down a touch this morning. US futures, NASDAQ futures down 0.4%. See you tomorrow. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris with the conversations that matter, and here's what's coming up on today's program. Bloomberg reveals Apple is ditching efforts to build an electric car and switching its focus to AI and mixed reality headsets. The European Commission president says Ukraine's allies should consider using profits from frozen Russian assets to buy weapons for Kyiv, warning Europe must prepare for the risk of a wider war. Plus, congressional leaders meet President Biden as efforts to avoid another U.S. government shutdown ramp up. So good morning, everyone. Let's take a look at the European markets map. We also have a full focus on banking in Paris. We're launching our newsletter today, and I hosted a great event with some of the top bankers to talk about also increasing headcount in the country. Now, European stocks for the moment, a little bit of a struggle to get traction. U.S. futures also slipping. Again, traders bracing for a lot of economic data in the second half of the week. That will help determine the path of monetary policy. And of course, in terms of the actual stocks we watch, we look at Apple and Klarna, who's potentially looking at an IPO in the U.S. Now, let's bring in Bloomberg's Noor Al-Ali to talk about the markets. Noor, a lot of the focus still on that data coming, of course, from the U.S. a little bit later on. I think there's also the preferred indicator of the Fed to look at inflation. What are you looking at today?
Yeah, absolutely, Francine. And you do see that rates traders are actually starting to succumb to the idea that perhaps the Fed was onto something with their dot plot. And now you're seeing that they're actually betting of Fed rate cuts of about 25 basis points cuts, so that puts it around 75. It's pretty much in line with the dot plot. We've had some reporting overnight on that, and you're starting to also see, that bond bull market really seep into the idea. We've got, we had the New Zealand Central Bank news earlier today as well, less hawkish than expected. That dovish tilt that's starting to kind of feed into the idea or add to the idea that perhaps that bonds now, they could be getting that bullish momentum that we've been waiting for quite some time now.
So, Noor, is there anything else? I know there's been a lot of talk, of course, of Japanese equities, some contrarians, and actually what Japan will do next. Is there anything outside what we talk day in, day out that we should keep an eye on?
Yeah, absolutely. Look, I think with the yen here, and concerns about, or speculation that the Bank of Japan is going to raise rates is definitely going to get that yen in a direction that potentially may not be favorable for stocks. But, as you've heard from Mark Cudmore recently in the other shows, perhaps even yesterday, you'll see that Japanese stocks are really rallying. You know, if you look at, and I did this amazing chart today that looked at all stocks performances globally since COVID, so since that dip that we've seen in 2020, and you'll see, in fact, that Japanese stocks, along with the U.S., even though now Japanese have outperformed recently, have really been star outperformers relative to pretty much everywhere else in the world. If you look at China, though, however, they've really lagged and they've really underperformed. So you can see that the story there is shifting for Japan. Obviously, U.S. stocks have been rallying on that tech, on that tech rally and that feed. And now with speculation of us pushing back those Fed rate cuts and the dollar being surging, I think there's potentially room for a pullback. But the idea of momentum is still very much there for stocks. And it feels like it'll be a fool's errand to go against that right now.
Noor, thank you so much. Noor Al-Ali there from our markets team. Now let's continue talking about the markets. We're also joined by Vincent Juvins, global market strategist at JP Morgan Asset Management. Vincent, thank you so much for joining us today. It does feel like a big week towards the end of the week in terms of data points that we're getting from the U.S. Apart from, growth of inflation, do you have a metric to look at to see whether, first of all, growth continues in the U.S. and whether a soft landing is definitely a given?
Well, the U.S. is all about the U.S. consumer, obviously, since it accounts for 70% of GDP. So it's clearly the health of consumer balance sheet that we're still monitoring almost on a daily basis. You see the health of the job market, which obviously support income growth in the U.S. Inflation is an important parameter as well. We're now seeing that in the West, in the U.S., in Europe, you have finally wage growth outpacing inflation. So clearly, this provides a boost to purchasing power. This should obviously continue to support consumption. In the US, there's another element which has supported growth quite meaningfully over the last couple of years. It's obviously fiscal policy. In an election year, we would expect obviously no major change to the fiscal policy, but the fiscal stance will inevitably in 2025 and beyond probably become less supportive. But to your question, clearly, U.S. consumption remains by far obviously the most important element to assess the health of the U.S. economy.
Vincent, I mean, there's a lot of questions about the labor market, and of course, we'll look at the dot plots to try and give us an indication of how quickly or how far the Fed can start cutting rates. It's very clear, well, at least for now, it's very clear that the next move is probably a cut. But how do you navigate the markets in this environment?
Well, I must say that the market expectations since the beginning of the year have become a bit more realistic. We were a bit surprised by the Fed pivot in December to pre-committing to 3 rate cuts for this year, which the market interpreted at 7 or 8 rate cuts, obviously, which was back then a bit exaggerated, obviously. Now, we're looking at market really expecting something like 3-4 rate cuts in the second part of the year, which in our view is more realistic given the economic backdrop that we have just described. So from a market perspective, I think that the market movements in the beginning of the year have been more healthy in a sense. It's not anymore built on the expectation that we will have massive rate cut later this year. I heard you discussing fixed income market. It's clearly an environment where, again, I believe it's really time to push cash at work and come back on fixed income market when 10-year yields dropped to 3.8 at the end of last year. This was probably a bit too fast, too low, and now we have recreated some value again, not only for sovereign bond and in terms of duration, but credit market at the moment, and not only in the US, but are really the place to be in the current environment. And rate cuts will come, probably not as fast and as much as expected at the end of last year or the start of this year, but it will be enough, obviously, to provide a massive tailwind to the fixed income asset class.
Yeah, is there a danger that actually if cuts don't come sooner rather than later, then it counts like a policy mistake, and that's when you start some of the labor market dynamics and some of the economy unraveling?
Well, at the moment, you continue to see inflation trending down with hiccup underway, which we expect, obviously, but we are still looking at both in the US and Europe inflation getting close to 2% by year end. So clearly an environment where the central bank can deliver those rate cuts. I would say for fixed income market, whether we have 3 or 4 rate cuts, won't make a major difference. If you enter this market at the moment, only for the carry you get already on credit market and in terms of duration, it's worth considering. And you know that ultimately later this year, maybe at the start of 2025, you will have this rate cut coming, which will provide on top of this nice carry that you have at the moment, decent capital gain. So the story is the same this year, and it has been after every, let's say, end of tightening cycle in the US and globally. Once the Fed and central banks stop to hike rate, it is a perfect environment to push cap at work, certainly in fixed income market and to some extent on equity market. And we have seen this again since the start of the year.
Vincent, what's your take on earnings so far? I know 2023, there were a lot of forecasts going into the year of lower returns or certainly lower margins. It seems to have been a pretty good crop in terms of earnings overall, but there's this difference between if you do well and you give back to shareholders, then you're okay. But if you disappoint, you really get slammed in the markets.
Yeah, clearly. And when I say that, I think that the market movements since the beginning of the year are healthier, certainly in their rate expectation. They're also healthier because they're really this performance is based on good earnings foundation. So last year we saw that especially US equity market was almost priced for perfection, given this AI boom, the tech the concentration within tech that we've seen last year. We've seen that those tech companies have really delivered on promise. Really, you've seen strong earnings growth from that part of the market. And as you mentioned, also tech companies also increasing their dividend, increasing their share buyback program and so on. And it's a very central theme that we have at JP Morgan Asset Management globally, the ability of corporate to hand over cash to shareholder, either in buybacks or in dividends. Clearly, the dividend theme is one global theme, which is to us very attractive in the current environment. We've seen historically that at the end of a tightening cycle, dividend equities tend to do well. You find them in the US, a bit more in Europe, and you find them more and more in Japan. Japan is clearly a market where you see this reform of corporate governance leading to a higher handover of cash to shareholders. So it is really an overarching theme, I would say. So earnings season was clearly good in the US, thanks obviously to tech sector, a bit less encouraging in Europe, where obviously it's a bit more dispersed. You have a bit less. We don't have tech obviously in Europe. Healthcare was quite good so far, but it's fair to say that it's hard for European equities to outgrow US equities at the moment.
So, Vincent, if you look, though, at a part of the market, and I'm thinking of the Magnificent Seven, but also a part of the tech in general, it does seem priced to perfection. What will be the support to some of these valuations going forward?
Well, as long as they continue to deliver on the earnings front like they've done so far last year, I believe we should continue to remain exposed to this sector. We should look at the impact of AI beyond the tech sector. AI will be disruptive for plenty of sectors, including our own sector. At JP Morgan Asset Management, on our investment platform, we use AI to help us managing our funds on behalf of our clients. It will be important also in the healthcare sector. It is going to be disruptive in many sectors. So it's our role as asset manager to identify which are the sectors which are going to benefit from it in the future. Not to speak obviously about your sector, the media sector rely already a lot on AI since many years in terms of production of content and so on. So clearly this technology is disruptive and it's an investment theme, which is a long-term investment theme, as I would describe, which we need to capture as an asset manager.
Yeah, no AI on the pulse, Vincent. You're absolutely right that the trend for media has been going that way. Vincent Givens, global market strategist at JP Morgan Asset Management, joining us, of course, to talk about the markets. Now, coming up, why have the biggest banks on Wall Street been ramping up their staff numbers in Paris? We'll discuss that next, and this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Now, the heads of major U.S. banks in France, including Morgan Stanley, Citigroup, JP Morgan, and Goldman Sachs, say Paris is the new trading hub in continental Europe since Brexit. Now, speaking in our Paris bureau, they said the pool of talent and new political measures have really boosted the profile of France despite high labor costs.
Paris for us is a hub. Clearly, it's our continental Europe hub. We've grown from 250 employees to more than 900 now.
We had 170 people before Brexit. Now we are more than 400, and we have extended the office, opened a second trading floor to be able to cope up to 600 without having to move again.
A lot of things have happened already, and that's why we have 400 people on the ground today, and we will probably continue to grow, but at a different space.
In the end, we will have tripled our headcount in Paris between before and post-Brexit, and we feel that this may go further in the future.
What really made the difference is President Macron, the measure he took to make France more attractive. And also, in my view, what really made the difference more than anything else was the pool of talent.
The mathematics, French school, etc., is actually looked at from everywhere in the world as something that has momentum.
Where I'm the most challenged is it's on the overall labor cost in France.
The labor market is complicated in France. Having more flexibility is something that is important to all of us. And when you grow headcounts in an important way, it becomes more and more important.
We are a cyclical industry, and that we need to be able to be flexible on headcounts.
You need to tell the juniors, the graduates, if you want to have an international career, you can go to London, you can go to New York, but you can also go to Paris, because Paris is becoming much more international now.
Well, the heads of these major U.S. banks in France were speaking, of course, an event organized by us here in the Paris Bureau. That's why I'm here to promote our Paris newsletter. Subscribe to the website, subscribe to the newsletter. It's really great fun. Our Lionel Laurent, who was also then interviewing a regulator, was there. And it's worth it to understand the dynamics that if you don't live in the country, sometimes you miss. Now, let's also bring in our city editor, Catherine Griffiths, who's been following the UK post-Brexit finance and story regulation. So, Catherine, thank you for joining us. I mean, it was interesting seeing it from the French point of view, because a lot of the Parisian, I guess, chief executives of some of these big, hubs of Wall Street banks were saying they also need to convince their guys back home. So the chief executive, Jane Fraser's of this world, and of course, the Ted Picks, that they need more headcount because it's so difficult to get rid of people, and they're so much more costly because of everything that goes with it. So who currently has the upper hand when it comes to Paris and London?
Gosh, I think probably London still has the upper hand, but we've seen all these trends, certainly lots of jobs moving to Paris, but in overall numbers still quite small. But then I think increasingly, actually, people are coming up against this point about the labour laws. So as some of your people that you interviewed have just demonstrated, banking is a cyclical business, finance is a cyclical business, and people get paid a lot of money. And so the way those institutions work, they need to be able to lay off people when needed. And you know, those people pop up somewhere else. But the laws in France are prohibitive to people being able to do that. The severance pay is just enormous in comparison to places like, say, London or New York.
So Catherine, again, to what extent is the labour law, so nothing really to do with finance, that's holding Paris back?
Yeah, I think, so I suppose there's a sense of hub, isn't there? Just as London's huge value is the things it brings together here, the law and the professional services, and also all the banks and the asset managers and all the rest of it. And that's the kind of hugely precious thing. And Paris understands that, everyone understands that around the world, this nature of hubs being so valuable, and is trying to create one. But one important slice is the labour laws. It's so key, particularly when you're in an industry where people get paid lots of money.
And Catherine, some of the banking executives here at the event yesterday were also complimenting Emmanuel Macron's policies. I remember he talked about, rolling the red carpet, rolling out the red carpet for a lot of financiers and financial services companies to come to Paris. How does the UK government compare?
Yeah, I think the UK government doesn't compare terribly favourably, at least sort of in the sort of world of kind of anecdotes that pop up about this. So banks feel very pleased with the engagement from Macron personally and from sort of senior emissaries he's sent over to London to kind of engage with senior bankers, particularly some of the US banks, come over to Paris and we're listening. What is your laundry list of things that are important to you? And they feel that they kind of convey these messages and they get sort of conveyed to the Trésor and they're actioned, or at least they're listened to, and there's a sort of sense of efficiency. I think in the last few years, people have felt frustrated here in London that UK politics have been so tumultuous. I mean, they have in France too, to an extent, but there is certainly a sense that people aren't really listening in the UK government, or haven't been. Maybe there's a sense, actually, perhaps in the last year or so that it's improved, but also a sense that of people being jaded and weary of not being listened to in the years after the Brexit vote.
Catherine, thank you so much. Our city editor there, Catherine Griffith. Now, we'll have plenty more, of course, on this story. Also, Bloomberg understands that Apple has abandoned its decade-long effort to build an electric car. So we'll have more on our Bloomberg Scoop next. This is Bloomberg.
This will probably go down in history as
Paul from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
All of this, we're joined by Bloomberg's Alex Webb. Alex, good morning. So how did we actually get here?
It's really been a decade of fits and starts. They started this project back in 2014 under the slightly ominous name Project Titan. Of course, it's elicited plenty of Titanic metaphors as a consequence. When I was reporting on Apple's bank from San Francisco back in 2016, that's when they first tamped back their ambitions in the space, realizing that it was actually pretty complicated to make a car. Over time, they then tamped it back. They decided they weren't going to build a car, but they were going to build autonomous driving systems. Then they saw how Tesla went sort of stratospheric, and they said, actually, no, we are going to, well, they didn't say, but internally, they decided they are going to build a car. Finally, though, with the slowing of the electric vehicle market over the past few months, over the past year or so, it seems as though that's driven some of the decision-making here. The crucial thing, of course, is the one time that Tim Cook spoke about his company's automotive ambitions on the record, he said they saw self-driving cars as the greatest AI challenge. Well, of course, now we're in a very different environment for artificial intelligence. There are a lot of very, very big AI brains working on Apple's self-driving vehicle. Moving those people to other AI applications may be more beneficial for Apple's core business, which is, of course, selling iPhones.
Alex, thank you so much. As always, Alex Webb, of course, will join us throughout the day to also understand how big a blow to the EV world and to Apple this is. Now, coming up, we'll talk insurance and AI. We'll be joined by Mario Greco, the Chief Executive of Zurich Insurance, to take a look at how AI is also changing the insurance industry. That's coming up shortly, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Now, Bloomberg reveals that Apple is ditching efforts to build an electric car and switching its focus to AI and mixed reality headsets. The European Commission president says Ukraine's allies should consider using profits from frozen Russian assets to buy weapons for Kyiv, warning Europe must prepare for the risk of a wider war. Plus, congressional leaders meet President Biden as efforts to avoid another U.S. government shutdown ramp up. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris. So artificial intelligence is bringing about sweeping changes across industries, and of course the technology redefines how business function and speak to clients. The insurance sector, for example, is facing a pretty big change through digitization and customer-facing, but also back-end channels. In the last 3 years, Zurich Insurance has invested over $1.8 billion in technology. Now, for more on this and the wider industry, I'm delighted to be joined by Mario Greco, the Chief Executive of Zurich. Mario, as always, thank you so much for giving us a little bit of your busy schedule to help us understand the insurance world. When you look at AI, I know this could be facing, for example, cybersecurity, but it's also how you speak to clients to capitalize on some of the relationships. Where do you see the use of AI actually ending?
The great majority today of our investments in AI is on customer-facing initiatives, solutions. We use AI to deliver better services to customers, to understand the risks better, and to improve the customer satisfaction. Of course, the issue with AI is where will AI go and what dangerous threats will AI create over time. But at the moment, AI is an incredible benefit for us for customer satisfaction and customer developments. And that's the reason we're investing so heavily into it, both in technology and in people.
Mario, there's, of course, a large number of the population worldwide that is still not insured. Can AI also help with this insurance gap, as it were, by making it more affordable?
Yeah, one thing, Francine, that I'd like to clarify on this is, because often I hear discussions on gap of protection and climate. I don't see that. I think people find opportunities to insure themselves for climate. It could be expensive, but it's out there. There are other forms of insurance for pensions, for health, for cyber, which are really not there. And this is where we, as an industry, and the governments, and the association, the stakeholders, have to find solutions for. Because there are reasons why these kind of risks are not insured today. And I don't think AI will help in finding the solutions. I think we need a different approach from governments, from stakeholders, in allowing the solutions to be available to people.
And this is a really interesting, of course, topic that also, I guess, touches generative AI. I don't know whether there are things because of climate change, but also because of our use of AI that you see becoming more insurable. Are there products or events that you think going forward will be much more harder to insure?
I don't think they will become harder. I think they will become more expensive. And I don't think, honestly, that this price differential is unfair, because what's happening through AI, through digital, through computer, is that we understand better the individual risk that some factories, some plants, or some houses, or some specific installations and locations represent, which means that all the other people will pay less because they're not subsidizing these risks. And so it targets the riskiness to individual risk elements, which again, it is fair. Now, what to do sometimes we'll need some social solutions, because some risks could just become excessively priced and too expensive. And then we need to figure out what to do. A lot of this also, it's about prevention. And, we've been investing a lot on working with the customers on prevention. This has been the highest growth part of our business over the last 4 or 5 years. And we continue to invest on the team of people who do prevention with our clients.
Are targets for net zero that the world has set itself still achievable, or do we need to get ready for a world where temperatures have risen by 1.5% or 1.5 centigrades? And what does that mean for the insurance sector?
I think we're already in the situation that you describe. I think the world is already warmer. I think we are already there. And I think we need to face the consequences of this, which makes prevention so important. And it means also working very, quickly and dynamically with all the people to minimize the impact. I'm very concerned about heating. We've been working with a number of big cities on what to do about heating of their, cities, and then the impact on their citizens. I'm very concerned about water shortage and availability of water. And these are all the things that we are keen to work with, mayor, with organizations, with governments, with individuals. We're already in that scenario.
Do you worry that there are more risks of U.S. social inflation keeping on rising? And of course, this is a term that describes insurers' claim costs that are increasing above the economic inflation.
Yeah, but not that much, honestly. I mean, social inflation has been there forever. It goes up and down. It changes depending on the years. And we're never going to get rid of it. I don't see today this as a major threat to the insurance results. In our books, we have a relatively limited impact because we have shrunk casualty exposure, which is where social inflation manifests itself over the past years. So I see it, but I don't think that for us or for the industry, this is the biggest risk over the next years.
Mario, as of course one of the most important chief executives of one of the largest insurance companies, what keeps you up at night? What are you worried about the most?
Look, if I look back and if I think about the last 3 years, what should have been worrying me 3 years ago were the potential for a pandemic, the potential for a war in Europe, the potential for a war near to Europe, the potential for a recession, the potential for high inflation. Luckily, I did not see any of these things coming, and so I slept quite well. But this is what, if I wake up in the night, I keep thinking about what am I missing seeing, what I have not yet understood that it's coming on us. It is the unforeseen, the unexpected, that really a company as big as we are, tries to anticipate everything, but we did not anticipate any of these things that I just mentioned, and this is really what keeps me awake at night.
You had a good set of results and you gave back to shareholders. Is there a danger that, and this is not only Zurich, but your industry at large, financial services at large, are in a race to give back to shareholders, which is very much appreciated if you're a shareholder, but that means you're taking away capital from natural investments that maybe need doing?
Yeah, we're very mindful of what you say, and we consider that continuously. In our case, we have a business model which is run for cash. We want to create continuous cash. And so we think it's fair to give back a portion of this cash each year, which for us is 75% of what we create in profits each year. We want to give it back to shareholders. This is our commitment. But we keep investing heavily each year on developments like digital. We keep investing on the skills of our people. One of the things I'm very happy is about the growth of the skills of our colleagues around the world over the past years. We have kept growing the base of our employees. So we take a long-term view on everything we do. And with that, I think that our distribution policies are healthy, sustainable, and wise. But I understand what you mean, and we're very, very mindful and careful on that.
Mario Greco, as always, thank you so much for joining us in London today, the Chief Executive of Zurich Insurance. Now, let's bring you also some breaking corporate news that just crossed the Bloomberg terminal. Bloomberg understands that KKR is exploring options, including selling its controlling stake in India's JB Chemicals and Pharmaceuticals amid interest from potential buyers. Shares of the company, which is known as JB Pharma, have climbed 68% in the past 12 months, valuing the firm at just over $3 billion. Now, coming up, we talk U.S. politics as a deadline for avoiding another partial shutdown approaches. And in another bout of deja vu, we also discuss the Michigan primary results and what that means for a Biden-Trump rematch. That's next, and this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The threat of war may not be imminent, but it is not impossible. And the risks of war should not be overblown, but they should be prepared for. And that starts with the urgent need to rebuild, replenish, and modernize member states' armed forces.
Well, that was the European Commission President, Ursula von der Leyen, speaking this morning at the European Parliament in Strasbourg on European security and defense. Now, to discuss European and U.S. politics, we're also joined by Bloomberg's EMEA News Director, Ross Matheson. Ross, thank you as always, because I know you're very busy, but I always love your analysis on trying to understand what comes next. How significant are these comments on defense from von der Leyen, also after what we heard from Emmanuel Macron a couple of days ago?
Well, it's just interesting to see European leaders much more vocal, talking out loud what they were probably thinking for some years, and that's that Europe really, for decades, neglected its own defence, probably relied a bit too much just on the fact that NATO existed, collective defence, this umbrella of deterrence, while not supporting their domestic defence industries, not building their own equipment. And certainly we've seen that show up in the shortages now that many countries in Europe are facing because they've sent so much equipment over to Ukraine in its war against Russia. So a real realization that a fundamental shift needs to happen here. The question is how? How do they get energy back into their domestic defense sectors? How do they get the equipment that they need? And how can they work collectively more than just using the idea of NATO itself in future defense? Because the question is, with Russia succeeding more on the ground in Ukraine, in the longer term, what are Vladimir Putin's goals when it comes to the rest of Europe?
So to U.S. politics, congressional leaders have also expressed confidence in trying to find a way forward and avoiding this partial government shutdown. What if they don't?
Well, that's the question if they don't. I mean, they're talking more positively after that meeting yesterday involving U.S. President Joe Biden, but they are running the clock on this to avoid a partial government shutdown. And we've been here before, 3 or 4 times already in recent times with Republicans, hardline Republicans holding up these deals in Congress. If they don't get it, the immediate economic impact won't be massive, and it could be made up over time as they get backdated wages and so on. But it has, of course, unnerved ratings agencies in the past, so markets will be watching that closely. But what it really tells us is the state of politics right now in the US, the climate in Congress, almost nothing can get done. It's not just this government shutdown that's being held up, but obviously also a big package of aid for Ukraine, some aid for Israel, the question of the border with Mexico and migrants. All those packages are sitting stuck in Congress at the moment because we're in the election cycle there. Republicans have their positions, Democrats have their positions, and no one seems willing to reach a deal.
So meanwhile, both Trump and Biden claimed victory in their party's Michigan primaries. What do these results actually tell us about the mood around President Biden?
Well, it's interesting because obviously Joe Biden and Donald Trump had a fairly clear path to victory in Michigan from the results we've seen. But we did see around almost 15% of Democrats, they decided to go for non-committed in Michigan, which was really a protest against Joe Biden for his handling of what has been the relationship with Israel for its war against Hamas in Gaza, and this growing concern, obviously, about the civilian casualties that we've seen in Gaza. And Michigan has a large Arab population, and they were obviously voting with their feet there. But it also just points to that broader question that not all Democrats see Joe Biden as the best candidate for them come November. Obviously, he is the main candidate being the sitting president, but there are those reservations about him around his age, around his capacity, and also around his policies, including his handling of this conflict. So it's interesting to see just how significant that level was.
Ross, thank you so much. Our Bloomberg EMEA News Director, Ross Matheson. Now, of course, we'll continue keeping a very close eye on U.S. politics and a possible government shutdown. To Nigeria, also, and the country's central bank has delivered a jumbo rate hike to tackle runaway inflation and stem the collapse in the country's currency. We're now joined by Bloomberg's Ondiro Ganga in Kigali. Ondiro, just how bad is Nigeria's inflation crisis?
It really is, because the cost of basic goods and services are skyrocketing. Inflation is at 29.9%, with food inflation at 35.4%. And the trickle-down effect is Nigerians cannot afford to put a plate of jollof on the table because the cost of rice per kilogram has increased 98%, onions 97%, tomatoes 81% in a country where 40% live below the poverty line. And in acknowledging this, the central bank governor Olayemi Cardoso attributed it to high cost of energy. He also pointed a finger of blame at insecurity in food-producing regions and also pass-through effects of the exchange rate. This explains why we saw that jumbo rate hike to try and mop up excess liquidity, also to try and ensure that they bring down inflation, manage the volatility of the currency. But until that happens, Nigerians will be out in the streets continuing to protest the high cost of living.
Thank you so much, Chandira Oganga. They're on the very latest, of course, in Nigeria. Coming up, Macy says its plans to close almost a third of its U.S. locations. Well, we have the details next, and this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
This is Bloomberg.
Fashion, as quick as it is to change, like in the kind of aesthetic, it's very difficult to change a system, right? And I think that comes down to who makes decisions. And the people that make decisions in fashion don't typically look like me. They aren't typically women all the time. When we look at who's at the helm of the biggest high street players, it tends to be the same type of people. And so I honestly think there's a lot of work to be done. Progress has definitely happened, but you only have to look at the last New York Fashion Week, which is the biggest and the most commercial, to see that, there's so much tokenism around what inclusivity really means. And I think that, especially when it comes to size, we're back where we were 20 or 30 years ago when you'd have one single black model that would walk down the catwalk. Now we're in that same situation where, you know, I can't remember the stat, but I think it's less than 3% of models that came down the catwalk were above a size 12. I mean, a size 12 is like less than average. And so there's just so much work to be done there. And it almost size is the last allowed taboo.
Well, that was Emma Greed, the chief executive and co-founder of the inclusive fashion brand Good American. She's also the founding partner of shapewear label Skims, which was valued at $4 billion last year. Now, you can see that full interview on Leaders with Lacqua at 9:30 p.m. in New York today. And then tomorrow it's at 6:30 p.m. in London. We discuss her rise to the top, how she measures success, and why diversity remains elusive in the world of fashion. So you don't want to miss it. She was really an inspiring conversation. Now, some big retail news out of the U.S. as Macy's says it plans to close almost a third of its U.S. locations. That's as the department store chain tries to fight off a pair of activist firms seeking to buy the company. Meanwhile, Lowe's says its sales will fall further this year as consumers continue to hold off from sprucing up their homes amid higher mortgage rates. Now let's go now to Bloomberg's Dasha Afanyasava. Dasha, thank you for joining us. So Macy's and Lowe's, neither painting a very positive picture in the U.S. Is there any reason to be positive?
That's right. It's not looking great, but I guess they're very different situations. In Macy's case, it is trying to make the case that it's better off as a retailer in the long term with its physical stores, and it's trying to kind of bridge that gap between the valuation, the enormous up to $8 billion valuation of its real estate assets, and then where it's trading on the market, and in this way fight the very aggressive effort to take it over by Arkhouse. But I think in terms of the consumer, I think in Lowe we see that there's just a lot of uncertainty. And I think in the past, when interest rates have been high, people would actually renovate their homes instead of moving. Now it seems like you're not even seeing that. People are extremely cautious, and that caution is expected to extend into this year, where it's also expected to see declines.
So the consumer goods company and Eurofin manufacturer Reckitt also missed sales estimates. It's now forecasting weaker growth. What does this tell us about Europe's consumer landscape?
Absolutely. I mean, I think with Reckitt, the incredible thing is that so many different things went wrong. And I think it's got all of these external factors, particularly in the US. It's got an issue with coming off that boom that it experienced because of formula shortages. So its formula was in very high demand, but now it's dealing with increased regulation in that market. It had an early cold and flu season back in 2022, which has made 2023 look weaker. So all of these things were happening at the same time. But I think fundamentally what it's seeing is that price rises are coming off, but volumes are continuing to fall. It's the more extreme version of what other consumer goods groups are grappling with, because they are actually beginning to turn things around and volume to come back to growth. But Reckitt, because of this plethora of issues, including there's also the Middle East, where revenue was lower than expected because local staff were misrepresenting it even. So there's all of these different issues, but also consumer issues underlying them.
Dasha, thank you so much. As always, Dasha Afanyaseva. Now, coming up, we'll have plenty more, of course, from Paris. Also, be sure to subscribe to our new Paris edition newsletter. That's why we're in Paris today. All details on your screen. We can also send you a QR code. Up next, Bloomberg Brief.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Apple is ditching a decade-long effort to build the electric car and pivots towards AI and mixed reality headsets.
Congressional leaders express confidence that they could avoid a government shutdown as time runs out to reach a deal.
And on the same page, bond traders align with the Fed outlook on rate cuts. That moment of capitulation. You can smell it, you can taste it, and you can see it. The rates markets.
Yeah, we're not fighting the Fed anymore, finally.
Would you fight the Fed?
Never.
Here we go. Let's have a look at these 10-year government bond yields. I mean, they're flat, they're phlegmatic, they're waiting for the PCE. They're perhaps not brave enough to get dug into these bonds until they see just how hot is the PCE. That's the estimate out there. 4.29 is where you are in the bond market. The 7-year auction went fine. The bid to cover ratio, 2.5 times. So it was pretty much in line. What the building estimate is, you're going to get a reverse Fed. Normally, it's the escalator up and the elevator down. It's going to be a reverse version of that. Unless something really, really bad happens out there. UBS say load up on the 7-year paper. The PCE, you're going to have a hot print to really shift this market. Crude is down by over 1% this morning. There are stockpiles in Cushing. If you want a barrel of oil, go straight to Cushing, Oklahoma. 8 million barrels of a build. The market is down. China's demand for oil will slow. We're going into a low growth phase in China. That is according to the narrative this morning from them. The dollar is up by 1/3 as you see this stasis in rates in the United States of America, and we're down to 3 cuts. That is the floor in the dollar. Good morning, Ms. Berger.
Good morning, Mr. Cranny. It was a sleepy day in equities yesterday, and it's turned into selling this morning. We're at all-time highs just about, so take some profit. S&P down 0.5%, NASDAQ down 0.7%. Maybe some jitters around talk of a gentle bubble. That's according to Capital Group. Maybe jitters around changing strategies. Apple, as we were saying, Manis, they're giving up their EV business and instead refocusing on AI. Just slightly down this morning, Apple in the pre-market, nothing huge. Meanwhile, CSI 300 down 1 1.33%. A lot of that is due to Country Garden. We did have a judge saying that it received a liquidation petition in a Hong Kong court. Those shares ending down some 12%. And also, Manus, China coming after the quants again, telling them they need to pull back on their strategies. So not the prettiest of mornings. Now, we do have recession probabilities, I should say, at about 40%. That is the lowest since 2021. This is a market that is expecting perhaps a soft landing. David Solomon was talking about this yesterday at a UBS conference, saying the market certainly perceives there's a very, very high delta to a soft landing. My own view, it is a little bit more uncertain than that. And that is the divide, Manus. It's not even just, hey, maybe we're not gonna get a soft landing, but there's also the other side of the coin. Maybe the economy will be too hot.
And those are the tail risks, aren't they? And this is what Stephen Major said in his sort of morning missive that goes online. Again, understanding what are the tail risks. I was drawn to the point that Solomon made about the consumer. You've got UBS, of course, that enshrined narrative here on Bloomberg Brief about the hedonism. Don't ever bet against the hedonism of the consumer. But you look at David Solomon is talking about paycheck to paycheck spending behaviors are emerging. And that is the sword of Damocles for the US economy. It's not accelerating, but it obviously is growing.
Yeah, although the top 1% did get a whole lot richer. I know we're going to talk about that later in the show, but it's harder to be in the top 1% now, Manus. So
it's much more difficult to be in the top 1% in Monaco, but we'll talk about that in a moment.
We certainly will. Let's now bring in our guest. It's Jeff Yu, Senior Market Strategist at BNY Mellon. Jeff, it's amazing how people can look at the same set of data and come with very different conclusions. So in your mind, what is the tail risk? Is it what Solomon says, that we might not get a soft landing, that the economy might be worse off, or is it the other side, that the economy might be running too hot?
If I could actually just bring it down to a micro level, what is the tail risk? Correlation, as in correlated trades right now. And that's the one thing I'm worried about. So if I look at the rally up in US stocks, I look at the moves in dollar yen and the lack of action in emerging markets, for example. It just seems a bit too easy right now to buy US equities and let it run and own dollars, giving you 5% front-end cash. So once that stops, and we're not making a call on when that's going to stop, and there's no alternative, then I think people are going to start to worry. So low volatility, the barbell approach to asset allocation, I think that really is a risk right now. We've sort of been here before, around 2018, 2019, but until then, I don't think the market wants to budge on current positioning.
So that sounds as if you're worried and you would go against the easy financial conditions. Global financial stress, not conditions, global financial stress is the lowest in 4 years. And that, some people are saying, builds this risk-on narrative, Jeff, which lets me short the yen and buy much higher beta propositions. Is that a folly at the moment? Are you not as exuberant as that?
Well, I respect price action. Put it this way, we must always respect price action, but at some point it's going to start to deviate with fundamentals. I mean, you mentioned dollar yen. So dollar yen at these levels, sure, there are fundamentals going on in the Japanese equity market, but by definition, if your corporate earnings are going to start to rise thanks to FX translation, that current account is going to start to weigh on dollar yen itself. Your currency needs to strengthen. You're going to be importing inflation again otherwise. So those cracks are going to happen. And corporate earnings in the US, can it match up? And to the points you and Danny earlier made about spending, can the US consumer catch up? Because consumers globally are certainly not going to catch up at this point. It's just total reliance on one group at this point. How long can it continue? That's what I am concerned about.
And Jeff, I love how you put it. It's too easy to buy stocks, own dollars, pick up that cash at the front end. But if I wasn't doing that, I would be missing out on a whole lot of returns this year. So if I don't want to be, I guess, picking up more than pennies, but let's say pennies in front of a steamroller, what do I do and still not miss out on those gains? I mean, it's the classic FOMO dilemma.
Absolutely, and you've just highlighted it. If you are going to deviate away from the benchmarking far too much, and then you're going to be under pressure. So there is no alternative now at that point. Having said that, you want to identify the areas which are just so excessively under-positioned, and I highlight emerging market bonds all the time. That's one area where we look at our underlying custodial flows, and the investment just hasn't been there. So would you rather pick up, let's say, 1.5% in real yields in the US, or maybe 300 basis points in Latin America. So at what point does your risk reward start to shift to some alternative assets, bit by bit, start feeding, into the areas which have been under-positioned? So that can also be taking away some of the exuberance in these overcrowded markets, but staying with that risk-on narrative. Again, buying emerging market bonds, it's not exactly, I'm saying, risk-off per se, but there are other options out there, and I just think it's time for markets to start to explore that.
I think it's very interesting when you move geographies from the Middle East to the UK to the United States of America, the proclivity to look at EM, as you talk about it, Jeff, is perhaps a little bit less because we have got that home bias here. Can we shift the discussion? We talked about a capitulation in the rates market. Finally, I mean, David Solomon, I think, summed it up beautifully, didn't he, Danny? He talked about, rates decisions every 2 minutes. 2 minutes ago, we were 150 basis points. Here we are at 75, 80 basis points of a cut. Now, translate this into FX for me. It perhaps puts a floor under the dollar, but you would say that we are underestimating the cuts that will come from the ECB. The market is not discounting aggressive enough cuts from the ECB, and therefore we are underpricing the risk of parity.
Well, certainly, if you look at Bloomberg headlines over the last 2 days or so, some ECB members saying, just questioning whether rate cuts at all are needed this year, whereas there are others saying, March shouldn't be off the table either. So I think Madame Lagarde is trying to guide things, towards a June kind of level. But once it starts, and I look at the import data in Europe, it's just collapsing everywhere. There's just no demand in the Eurozone right now. And I still question the view for some of the ECB hawks to be fixated on wage growth in the Eurozone, which frankly is not that sensitive right now to financial conditions, largely because it's private sector driven. So, sorry, public sector driven. So as a result, they need to focus on easing financial conditions for manufacturing. It's only going to get softer right now. We're seeing it in the hard data, so it needs to happen.
What about the UK? I mean, there's even been Andrew Bailey saying, we don't need to wait until 2% to start cutting. You have Megan Green saying she's not convinced yet. It's a divided BOE too. If that's the position of Europe, where does the BOE come into play?
Well, ultimately, I think the BOE is actually in a much better place, so to speak, in terms of not needing to worry too much about cutting rates at this point. I still think August is when the first cut is going to be, from the BOE. So if there's one thing that sort of is the common thread for US households and UK households, despite interest rate hikes, that hasn't exactly eaten into household servicing because real wages have risen commensurately, if not more. So spending power is still there. And on top of that, election year, I think there are going to be fiscal giveaways, and even if there is a shift, greater expenditure into public services as well. So I'm not too concerned about UK growth right now, driven by services. Relative to Europe, Europe is manufacturing where we need to worry about, so lower euro sterling as a result.
Are you modeling just a generally higher for longer than is overall anticipated in the US, in the UK, and okay, you sound fairly punchy on the Eurozone, Jeff, so I'm not going to try and tackle you down there to sort of go much higher for much longer in Europe. But do we need to start thinking about rates at around 3.5% over a longer period of time than perhaps harking back to the halcyon days of 0% rates or 2%? I mean, just get with the program.
Well, let's see, a few years ago, we were talking about secular stagnation, right? So if it's going to be secular stagnation, 0% growth or very low growth, then by definition, rates need to be grow as well. No one's talking about secular stagnation, right now. So the power of wages and that as a composition of economic growth, and that really has started to pick up. So basically, wages, so basically, I would say rates need to stabilize at a level consistent with GDP growth. So I don't think there's any change in our overall economic framework. It's just our assumptions about where growth is. That has shifted. Can it continue over a 5, 10, multi-decade horizon? I think that's a different story. Some people say yes, with productivity and AI building things, but others looking at demographics are more circumspect. So let's look at each individual geography. But right now, compared to a few years ago, no more secular stagnation. Does that mean higher rates where central banks bottom out? Absolutely.
I knew you could get AI into this conversation, Jeff, on a macro. Well done. Well done. We should have given you the $10 bet. Jeff, thank you very much. Jeff Yu at BK.
Thank you very much.
You're welcome. Good to see you, Jeff Yu there. We didn't even get to the Japan conversation, really. Let's get, well, there's time. There's always time on Bloomberg Brief. Some of the other stories that you need to know as you get ready for your day. President Biden and Donald Trump both cruised to victory in their party's Michigan primary elections yesterday. Trump defeated Nikki Haley and she has vowed to stay in the race through Super Tuesday on March the 5th.
As series of wildfires have ravaged the Texas Panhandle, Governor Greg Abbott has issued a disaster declaration for 60 counties. Residents have been ordered to evacuate or shelter in place, and a nuclear weapons facility has been forced to shut down.
Deutsche Bank's decision to force workers back into the office more often and more frequently has met with fierce internal criticism. A memo sent to top management says a large number of employees have made critical remarks about the requirement to attend the office 3 days a week.
I kind of get that. If you moved your life during pandemic far away and all of a sudden you have to come back in, I'd be unhappy.
We were here 5 days a week, the whole way through the pandemic.
But we didn't move our lives far away.
Water cooler culture.
We differ on this a lot. We'll discuss it in the break. Coming up, Apple puts the brakes, let's get out of this, puts brakes on its decade-long electric car project, leaving the tech giant searching for the next big thing.
And the risk of a U.S. government shutdown dips as there's newfound hope of a deal. It could emerge. We'll tell you what it is on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Brief. I'm Menace Cranny alongside Danny Berger in New York. Now, a Bloomberg scoop. Apple is cancelling a decade-long car project and it's shifting its focus to generative AI. The tech giant's sales continue to struggle. In 2017, it was Tim Cook. He spoke to Bloomberg about the company's automotive ambitions.
We sort of see it as the mother of all AI projects. It's probably one of the most difficult AI projects, actually, to work on. And so autonomy is something that's incredibly exciting for us. And but we'll see where it takes us.
Joining us now is Alec Webb. So 10 years in the making, 2,000 people involved in the project. It's always a hard decision to walk away from an idea, but this is a reality check at Apple, isn't it?
Yeah, it's the latest in a real stop-start process, which finally seems to have stopped in a finite manner. Over the past decade, they've at various stages tamped back their ambitions, expanded their ambitions. At the stage when Emily Chang spoke to Tim Cook in the interview just showed, they had decided they weren't going to make a car, but they were going to build these self-driving car systems, which then they might sell to other people. They then saw how Tesla went on a real tear, at least its share price and its sales. And so they reignited those ambitions to actually manufacture an electric vehicle. Now it seems to have finally died. The reason, of course, pertains seemingly to partly that AI ambition, and secondly, the electric vehicle market. The electric vehicle market is really slowing down. The growth is slowing. But Apple seems to have missed a beat when it comes to artificial intelligence. It doesn't yet have a big public-facing generative AI product. A lot of very big AI brains have been working on its car project. You can see how it might make strategic sense to move as many of those as possible into the core AI ambitions.
So now the calculus for them is they presumably thought, okay, we were going to have an electric car in the future that could add another revenue source. That needs to be replaced with AI. But Alex, are they too far behind? If everyone else is so advanced, I mean, we can talk about the Google missteps or the fury over that, but if they're so far behind at this point, can they catch up to make sure they capture that revenue source in the future?
I don't think it's too late in the AI process. We're still very, very early in this sort of artificial intelligence revolution. It's kind of an evolution because it's going to take a long time, right? There's lots of things that are yet to come. The challenge is that how quickly can they do it? As you say, there are products already out there. They are able, the advantage of Apple's model is that, of course, you can use ChatGPT on the iPhone. You can use a lot of the things that are out there already on Apple's platforms. It's just the way they're integrated into Apple's offering that is going to be the differentiator. Coming at it a year or two later, 3 years later maybe, that is something that Apple's done with plenty of products in the past and still managed to make big successes of them. But it also, I think, speaks to why there is this big decision now in order that they can get to that point.
Well, you just got to hope that late may mean a perhaps magnificent and more dramatic entrance relative to their peers. They've got a balance sheet. They can buy whatever the heck they want. I know that that's not usually the chosen road for Apple, but they still got that ability. Look, they've also got litigation tail risk, don't they? We understand, and this has been ongoing for some time over the App Store, over a whole variety of issues, but they've met with the DOJ in a bid to avoid an antitrust suit. So what's the suit they're trying to avoid and close off with a deal?
Yeah, I mean, the full details of exactly what is going to be prosecuted or could be prosecuted here, we're yet to see. But it's broadly to do with the way that Apple is perceived to have maybe closed out some of its competitors. So, for instance, if you're Spotify, you would, and somebody signed up for Spotify through an iPhone, you would have to pay, so Spotify would have to pay Apple a 30% cut of the subscription fee that it would make. So if it's a £10 subscription, $3, or $10 subscription, $3 of that would go to Apple. And crucially, though, Apple forbade anyone who was doing this sort of thing from saying, if you go to our website, it is cheaper, right? So if you go and sign up to Spotify on Spotify.com rather than through the Spotify app, Apple basically banned them from doing that and would not let their apps be sold through the App Store. So that is perceived in many quarters as anti-competitive. There are a couple of other examples along those lines. That's the sort of thing then that is now being tackled by regulators. We've already seen stuff in Europe. The DOJ seems to be up next.
Hey, Alex, appreciate it. It's Bloomberg's Alex Webb there on the latest on Apple. Okay, let's get a quick check on your bond markets. Kind of sleepy this morning, Manus. We're lower by not even a basis point anymore. We're asleep. The bond market is asleep. But we've capitulated. We're what, pricing in 78 basis points now of cuts? Basically where the Fed is.
Finally the hounds, or maybe it is the bulls, the rate bulls have been brought to heel. The matadors have gone to sleep.
It's the lesson we learn over and over again. Don't fight the Fed.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Wealth accumulation centers and concentration of excellence. That's what you want. That's actually what you mean.
Sorry, let me remember that for next time. I've already forgotten it, but you'll write the lines down for me. Well, if you want to be a millionaire from your 401k, that's gone up too, man. As Fidelity has data out, the number of 401k millionaires, that also is near a record right now.
Yeah, I mean, there's various generations of that. Gen X, 15 straight years of average balances. If you put your average amount of money in, you've got $500,000.
Maybe we're going to get some more Bitcoin millionaires soon. Have you seen the price of Bitcoin, folks?
It's just raced away.
It's almost at 60,000 again. Huzzah.
And it's actually, I mean, it's pumping, it is literally pumping on gas. We've got for 5 straight days in a row. And there's a real nice knock-on effect, isn't there, in terms of some of the other companies. You've got MicroStrategy, and then there's a few others out there. I mean, obviously, the other two are doing really well.
Yeah, Marathon, Coinbase. It's that mix of, yay, we have an ETF, it's easier to buy now. And let's be honest, if the Fed's going to cut this year, that's going to help Bitcoin. Surely, the risk on helps it.
Mike Novogratz must be just so happy.
Maybe we'll get another tattoo.
To the moon. Let's not talk about tattoos. Okay, coming up, we're going to...
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Apple ditches a decade-long effort to build the electric car and pivots towards AI and mixed reality headsets.
Congressional leaders express confidence that they could avoid a partial government shutdown as time runs out to reach a deal.
And on the same page, bond traders align with the Fed's outlook on rate cuts.
It's amazing to get that repricing in the rates market, 50 basis points higher in the front end since the end of the year, and equities are trading near all-time highs.
Well, as Jeff, you just said to us, it was just all too easy.
Yeah.
Buying stocks, buying the dollar, and just running it out. He said there's a huge amount of risk at the moment. He sounded a little bit cautious.
I have good news for you and Jeff.
Bring me joy.
Well, this isn't joyful. Maybe today we're finally getting the opposite of that. Maybe today we're finally selling equities. Sorry, not joy for our retirement accounts. However, here's what we got. S&P 500 futures down about 0.4% this morning. NASDAQ futures, those are doing worse, down 0.5%. There's a little bit of jitter, as there, has been always, around AI. Jeff, you, as Manus was saying, you know, it's all been too easy. You also have Capital Group calling it a gentle bubble in AI. We're also talking about Apple all day today, ditching its EVs, shifting now more towards AI. So it's just this theme alive in the market and nerves about it. Meanwhile, in China, we're down about 1 1/3. That's where we closed. Country Garden is behind that. Remember them? Don't forget the distressed property developer facing some issues in a Hong Kong court. Those shares ended down about 12%. China's also cracking down on the quants yet again, so getting a little bit harder to be a free trader in China. So Manus, those are your equities. Unfortunately, a lot of red this morning.
Yeah, a little bit of a dip in the red, and we get a hot PCE print tomorrow. It's really going to irk this market. So finally, the rate bulls have been tamed. We're now down to 75, 80 basis points of rate cuts. So finally, that narrative, as you said, Danny, don't fight the Fed is there. So 429 is where you are. You've got lots of houses coming. I'd say pick up your duration now, pick up 5s, pick up 7s, because this is potentially the top end. A PPI plus 0.4% is already in the price. Crude is down by 1 1/8% this morning. You've got stockpiles rising at Cushing, Oklahoma. China's oil demand is set to slow. We're hearing that from CMP. Low growth phase is where you're going to in terms of China demand. That is going to be brutal. OPEC Plus, will the extension be enough? That's what the market is asking. How long will OPEC Plus extend for? And Bitcoin, we just flashed the price for you just a moment ago, but it's worth noting this is up for the 5th day in a row. The highest since November 2021. Well done, Danny, on finding the stat for me. But we've got another halving coming up in the Bitcoin in the Bitcoin world, but this is a pretty splendid run.
I think we can add this to the list of things that are too easy from Jeff Yu, right? It's not just stocks, it's not just dollars. Apparently now it's Bitcoin. It's also credit, huge appetite for credit, and a lot of issuances coming out. Of course, Jeff says, because I asked him, I said, okay, what do you do? Because if you weren't buying those things, you would have missed out on a lot of returns. He said, go to the underloved things. Look at things like EM bonds. There are other assets out there. It certainly doesn't feel like that these days, though.
But in part of ways, when you're in this market here and you're dollar-based, there is that home bias.
Yes.
There is a lack of desire to really extend deep into beyond borders. By the way, David Solomon at Goldman Sachs, we've scaled up. We're a scale player in credit. They're at $130 billion. So, I mean, all hail that market. You like that market?
Yeah, I do like that market. A great piece out today, by the way, a warning flag on that private credit market. Whether you believe it or not is another question, but one to read.
Well, we'll certainly bring more of those interviews to you. Let's talk about the oil market because we've got Nadia Martin-Wiggins. She joins us now from Svelland Capital. Nadia, good to see you this morning. I look at the spreads. I look at the physical spreads in this market, and they are as hot can be. They're the highest and widest in 4 months in backwardation. And yet I look at the oil market, the futures market, and it does not reflect the tightness in the spreads. Now, you will very eloquently explain to me why there is such a vicious disconnect. Good morning.
Good morning. So I think the biggest difference here is the spreads especially reflect the physical market and how refiners see the market and how crudes are trading, reflecting physical differentials, and that is really strong. The market had expected builds for the most part in the first quarter, and instead we've seen draws. So that has really lifted that momentum in terms of crude buying ahead of the summer season as we get that seasonal jump in demand and as refiners come back from maintenance. On the other hand, the macro picture is really influencing that front price, so on WTI and Brent, and concerns about China, concerns about a slower rate of rate cuts and what that means.
Well, China's crude demand, to mention China, Nadia, it's expected to grow by just 1% this year. Does that mean we count China out as a growth driver for this market?
No. Absolutely not. I mean, last year we saw China, despite all the headlines, actually, in terms of end user demand, grow by 1.5, 1.6 million barrels per day, year on year. This year we're looking at around a third of that, right? So it is a slowdown, but it's still a very important player. And it will also depend on jet demand globally and especially in China, because we're finally seeing the real comeback since COVID, because we have the increased capacity amongst airlines. We have a good season in terms of China for travel. And so that can really drive some momentum earlier on this year before we look at the final year numbers, heading into Q2, Q3.
Look, far be it from me to wave a flag from a report, let's say, within China and the veracity. You've got to question the veracity of everything. CNPC forecast the lowest demand in a decade. We're going into a low growth phase. There is an adoption of electric vehicles. I mean, this is respectfully pushing back against all of the Western London, New York group think. This report challenges fundamentally where China demand is.
So we definitely saw that electric vehicles continued to do well last year, but it's slowing down, right? We have an oversupply of electric vehicles globally right now, and we see that especially through the export numbers coming out of China and really backing up in storage in terms of electric vehicles within Europe. That's the most visible place. So things are not going as fast as they were, and the momentum actually slowed down last year in terms of how quickly that changeover was made, and that is because China is not flying, so people are not, young people are not buying electric vehicles right now. On the other hand, of course, this transition is coming. It's very interesting when we think about the viewpoint of refiners, because refiners in China now, they have their full quota of allocations for crude imports, and right now, we have seen them buying very strongly since the Chinese New Year, and I would interpret that almost of, okay, they are buying the dip because start of next week, we're going to have the new official selling prices from Saudi Arabia, and it looks like because the refining margins are so strong that they're going to raise prices. So now is the time to buy and maybe talk things down a bit.
Right. Well, meantime, Nadia, for European refiners, they've had to look closer to home because of that extra cost right now of getting barrels that avoid the Red Sea. How thin is that pool of alternatives if European refiners need to continue looking beyond just Middle Eastern oil?
Yeah, so as you correctly point out, it is really about what is going on in the refining sector in Europe, because most of that pathway is actually used to import refined products from the Middle East rather than the crude side of things, right? We've had refinery maintenance in Europe, so it's been a very, very tight picture, and that is a real pull. That actually brings in this question of whether, for example, Russia is really going to go through with not exporting gasoline. Then when we think about that summer period when that takes gasoline then out of the entire global market. Of course, they were not exporting to either Europe or the US, but that makes a tighter picture overall when there is this stall in getting crude and product flows over to Europe. We don't have spare capacity in the refining sector in Europe and in the US. That is really shifting to the Middle East and Asia. And when you have these shipping outages and delays, the problems we saw last year, starting with Panama Canal and now spreading to Suez, it makes it much more expensive to ship oil. We have this TMX pipeline starting up in Canada. And if you're going to ship from Vancouver all the way over to China, that's $8 a barrel shipping cost right now.
Right. Hey, Nadia, unfortunately, we're out of time. We didn't get your price call, but you know what? We're just going to get you back on to get that very soon. Nadia, we really appreciate you coming in this morning.
We're still positive.
There we go.
Positive.
We'll take it. Nadia Martin-Wiggin.
It's going up.
It's going up. I like that as a call. Nadia Martin-Wiggin of Svelin Capital. More people should say that. I wish the sell side did that, Manus, on their equity call. What's it doing? They're going up.
It's called freedom. Freedom to make a call. Freedom to actually talk about a market and not avoid the question.
I love it. Okay, coming up, we're going to be joined by Myron Brilliant. He's the former head of global operations for the U.S. Chamber of Commerce. It's all about trade and politics next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Now, the chances of an economically damaging partial government shutdown this weekend, they are declining and optimism is rising in Washington. But Senator Elizabeth Warren has some skepticism.
This is the craziest kind of negotiation you would ever see. And that is that, as far as I can tell, everybody wants to deal, keep the government open. We've all agreed on what the numbers are. It's a budget deal, right? And everyone's agreed on it. And the Republicans in the House are just saying no. And it's hard to sit down and negotiate with somebody when you say, because you want what? And then some crazy thing flies in that the majority of Republicans don't even want, much less that you'll get Democrats on. So we're kind of in this shut down the government for what purpose? What are the Republicans trying to accomplish here? It's a kind of dysfunction that is not about Democrats and Republicans fighting each other. It's just Republicans who just can't seem to get their act together so that we do the most basic job of government, and that is fund it and keep it going.
Well, the goalposts, as we keep hearing, are moving on a couple of matters, including the supplemental emergency funding request for Ukraine, for Israel, for Taiwan. There's an effort in the House now to subvert the speaker. That involves Democrats and Republicans, a discharge petition that would bring defense only. It's a little different than the one you passed, and we'll see what they get on the border. Would you support an approach like that if it got the money to Ukraine?
Look, I think the key thing right now, and we were just talking about this among the Democrats just an hour ago, pass the bill that's already passed the Senate. We have Republicans, we have Democrats who voted for it. Ukraine needs the money now. The Ukrainians are running out of ammunition, literally. They need the help right now. This thing has already been vetted. It's gotten strong support from Republicans in the Senate. There are Republicans in the House who want to do it. There are Democrats in the House who want to do it. The path is there. All you have to do is just take it. Come on, Leader Johnson. Make it happen.
Senator Elizabeth Warren, they're urging both parties to take the path towards funding Ukraine. Let's stay on U.S. politics and bring in Myron Brilliant. He is the senior counselor at Denton's Global Advisors and former head of global operations of the U.S. Chamber of Commerce. Myron, we're so thrilled that you're able to join us while you're there in London. And I know you're there in London having a lot of high-level business meetings, talking to different folks. Yet back home for you over in D.C., as we're hearing the senator speak about, it's the same old story of dysfunction. Can't get funding done. Careening towards another 2 government deadlines in the middle of an intensifying rhetoric of an election year. From what you hear abroad, how reliable in the year of 2024 does the world see the U.S. as a partner?
Well, I think business leaders around the world have embraced uncertainty, and certainly we need to get the budget deal done. We need to find funding for our cause in Israel and the Middle East, for Ukraine, to support its approach against Russia's aggression. And this is a critical time for the people in Ukraine and for the government. They need American military support. So there's really no option at home. The politics are complex, they're divisive, we're in an election season, but the world is taking notice of what's going on in the United States and what's going on around the world, and it wants America's leadership. We can do that by getting the budget deal done, by getting funding for Ukraine, for the Middle East, and ensuring our allies and ensuring the world that the United States is going to remain at the forefront of global leadership. There are other issues as well to tackle, but these are 2 critical ones right in front of us this week.
Myron, I would be surprised, and I'd be curious to know, to get your reaction to this. You talk about U.S. leadership, but the U.S. has continued the tariffs from Trump to Biden. The U.S. has continued not to make the WTO work. The U.S. is not exactly what you call an evangelist at the moment of free trade. You're in the U.K. They don't have a free trade agreement with the United States of America. Do you think that American nation really cares about having a free trade agreement with the United States or with the UK? I mean, security, yes, I get it, but free trade, it doesn't seem to be a high priority for either parties with the United Kingdom. Lost cause?
Manus, you strike a chord with me. I've been arguing for a long time that we lead from the front, not the back. That means not having a protectionist agenda, whether it's Republicans or Democrats. It means pursuing trade agreements. In the United Kingdom, we pulled out of an important one in the Asia Pacific at the onset of the Trump administration. These are bad decisions. The United States should be at the forefront of the digital agenda. This is, of course, a topic du jour at the WTO Ministerial in Abu Dhabi this week. We need to see U.S. leadership, whether it's in the multilateral context or whether it's trade deals like the one that's been discussed before with the United Kingdom. The United States is best when we're buttressing the global system, whether that's through trade, whether that's through the G20 process, and of course showing leadership when it comes to geopolitical conflicts that exist in Europe and in the Middle East.
In that case,
yeah, we've got to do something better.
In that case, what would it mean if candidate Trump becomes President Trump 2.0 and fulfills his promise, as he's been saying in the campaign trail, of enacting a 10% tariff for all imports?
Well, we're 9 months out of the election. Clearly, we saw what happened in the Michigan primaries. We look like we're going to see a rerun of President Biden versus former President Trump. We'll see what his policies are. He has talked about a 60% tariffs on Chinese imports. He's talked about a 10% tariffs across the board on all goods. These are crazy policies. I criticized the weaponization of tariffs in 2019. He came on national TV, criticized me for that. I stand by that statement. We do not need to impose more tariffs. We, in fact, need to reduce the tariffs, and we need to demonstrate leadership when it comes to trade. This is a time where we see heightened economic nationalism in the United States and elsewhere. We see increasing populism all over the world. We need to fight against those principles, and we need to look at different values, including promoting trade, liberalization. We need to recognize the global South concerns. We need to recognize labor concerns, but we need a more proactive trade policy, and it starts with the United States taking on a new narrative.
Well, Myron, just for balance, obviously the Biden administration did not reduce all of the tariffs, did not appoint the judges to the appellate.
That's right.
So it's trying to sort of say it in a sort of slightly fair and balanced way. I want your reaction. Great when we have you on the Bloomberg, because we've got live headlines from Li Keqiang. So let's just give you them just for a moment to reflect. He talks about the U.S. decoupling. Li Keqiang talks about U.S. decoupling, not in the best interest of both nations. He says that enhancing economic cooperation is a win-win for China and the U.S. So again, this is the Chinese side. We've got Trump getting ready for more tariffs. My question to you is, the West and the United States of America have said to businesses, you know, the messaging has been decouple, disinvest, disengage. Governments really only have themselves to blame in terms of what corporates do, because if they're hearing this message at a government level, they're stepping back. What do you make of this very sort of first set of salvos of saving trade between China and the U.S.?
Well, first off, the United States-China relationship is the most important in the world today, and it's full of conflict and complexities. Trade relations between the two countries is being tested through technology, export controls, other kinds of restrictions, tariffs, of course, that were imposed during the Trump administration, but as you suggested, carried forward during the Biden administration. We have tensions that have been somewhat arrested by the President Biden, President Xi meeting in the fall, but we're not seeing the kind of progress, even though I'm encouraged by the military-to-military exchanges. I'm encouraged by the new dialogues around AI and commercial issues. I don't expect an election season to see huge progress, but there is no question out of Beijing a charm offensive. I was there in the fall. I saw a lot of the Chinese leadership. They conveyed to me, as they continue to convey at forums like Davos.
Were you charmed?
Yeah, Premier Li is really basically saying to everyone, the United States should come to China, that China is open to Western investment. The reality is we don't see it, though, in proof and concept. So that's the challenge, and I don't see huge progress in the trade relationship this year, but let's at least stabilize the floor. And there are risks. There's flashpoints like Taiwan. There are issues around technology. There continue to be sore points in this relationship. And expect more export controls and more restrictions on outbound investment from the United States. So each side can complain about each other, but at the end of the day, the two countries have a lot at stake, and the world has a lot at stake in this relationship being more stable, more calm, and frankly, more productive.
Okay, Myron, thank you so much for joining us. That is Myron Brilliant of Denton's Global Advisors. Come join us the next time you are in New York. Coming up on the show, market moving events for the day on Bloomberg Brief.
Connection lost.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
It's Bloomberg Brief with Danny Berger and Manish Cranny in New York. Okay, let's get you set up for your trading day this Wednesday. Here's what's ahead. We're going to get U.S. GDP for the fourth quarter. That comes out at 8:30 a.m. Eastern. Then more Fed speak if you haven't had enough. Raphael Bostic, Susan Collins, and John Williams, they'll all be delivering remarks throughout the day. Plus, earnings on deck. Salesforce, HP, Paramount, they're all among the companies that are going to be reporting after the bell. Manis.
Danny, good morning. Let's have a look at some of the movers. You've got Coinbase up, literally banging away here. You've got Bitcoin up for the fifth day in a row. It's at the bottom of your screen at the moment, up 4.5%. A few other stocks, Beyond Meat, soaring this morning. International sales doing well. And then you've got eBay, a strong holiday quarter, expanding the buyback plan. So that's all to play for there, up 4.75%. But wow, that Bitcoin is on fire.
It really is. And it goes back to what Jeff Yu was saying to us earlier, Manis, this idea that it has just been too easy. And it's too easy right now, and that's worrying. The fact you can buy stocks, you can buy dollars, you can buy Bitcoin, and you're doing okay, but maybe you won't for much longer.
Well, if it looks easy, sounds easy, you maybe want to question yourself and have a little bit of a hedge. I wonder, are bonds a hedge?
Well, he thinks EM bonds, that's the place to go into.
300% relative to perhaps a couple of percent of real return here in the US. That's it from Danny and myself. We'll hand you over to Bloomberg Surveillance. That's a good morning's work done.
Yeah, didn't break anything.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The overall market is still okay. I think the economy is still okay.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
The longer that these policy rates stay elevated, the more that they're going to bite into the economy.
The Fed is locked and loaded, so if there is a meaningful slowdown in growth, I think they're going to cut rates.
A market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Total capitulation. We'll be talking about that through this morning. Live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 down about 1/3%. We've got to begin with this name right here, Apple. The latest reporting from our colleagues here at Bloomberg. Here's the quote: Apple cancelling a decade-long effort, Lisa, to build an electric car.
A decade ago, it was thought maybe building a car would be the next, building a VR headset, that would be the next artificial reality type of new experience. And now what it turns out is it's a bad business to build cars. It is a very good business to say, we have something with AI in whatever form it is, and it will transform your lives, and that's going to really gain some more traction.
There's information in what they're moving away from, what they're leaning into, and how this market responded. The stock rallied. That tells you everything you need to know. And just to pull out a quote from our story, Apple had imagined the car being priced at around $100K, but executives were concerned about the vehicle being able to provide the profit margins that Apple typically enjoys on its products. This is a clear message. This is basically, we thought this might be a high-margin business. It's not going to be, so it's not one we want to be a part of.
And frankly, who is the poster child for them to learn from? Elon Musk. Because frankly, he keeps saying this is a tech company, and everybody else is saying, are ya? You know, because evidently building cars is not an easy business, and he's learning that the hard way.
2 emojis from Elon Musk just to respond to our story. Did you see them? I think one was the salute and the other was a cigarette.
Yeah.
I think he's feeling pretty good about their decision.
Pretty good, feeling very smug. You know, this just goes into the whole narrative of the EV market. The demand is also not there for the kind of cars Apple was trying to build. UBS said domestic EV sales will decelerate to 11% this year. It was supposed to be close to 50% growth. So we're seeing it from GM, Mercedes, all of these companies having to back.
This is a big message from Cupertino, California to Detroit, Michigan. And speaking of messages coming out of Michigan, need to talk about those primary results. So here are the numbers. Biden, 81.1%, uncommitted, 13.3%. Can we talk about that uncommitted 13.3%?
That's more than 100,000 voters. So more than 100,000 people came out for a protest vote. This is the issue Biden is going to have going to the general election. How many of those that came out for a message, including Representative Rashida Tlaib of his own party, in Congress came out for this protest vote. How many can the campaign make sure that they go out and vote for Biden in November and not stay home? We're not saying these are Trump voters, but the issue is when you have tight margins, and you just have to remember 2016, 10,700 votes was the margin that Trump took Michigan, and that is how he won the 2016 election. They do not want a repeat of this, and they have a lot more work to do.
So now we're in the general election. Can we say that we have 9 more months of this? We've been in the general election, it feels like, but now we definitely are, and we're going to be basically parsing the nuances of the people who are protesting the moment that they can't avoid. That's sort of where I feel like we're at. I just want to point out that back when Obama was running, I think that he got something like 10% of the, or about 10% of the votes being non-committed. So there is some sort of corollary here to people liking to protest with their votes.
Are you committed to election coverage now? Is that what you're saying?
You know, I am committed simply because there are things that need to get done. And I'm actually very frustrated that we're not talking about those things. I'll get off my soapbox. Now, as a journalist, we're going to have a long stretch here.
Looking forward to it. Another 9 months of Bramo getting very, very upset with Washington, D.C. Equity futures right now on the S&P pulling back just a touch. We're negative by 0.4% on the S&P, closing just short of another all-time high in yesterday's session. Yields a little bit lower, down a basis point, 428.95 on a 10-year. The euro at a weaker dollar stronger, 108.15 on that currency pair. Coming up this hour, Jonathan Stubbs of Berenberg with S&P 500 companies blowing past earnings estimates. Kim Wallace of 22V Research as hopes grow a government shutdown can be avoided. And Pierre Ferragu of New Street Research as Apple drops plans for EVs in order to gain ground in AI. We begin with our top story. Wrapping up earnings, S&P 500 companies heading towards their highest quarterly beat rate since the end of 2021. Jonathan Stubbs of Berenberg saying it's not all about the Mag 7, writing, quote, we see headwinds for the group from both our, quote, brave new world regime and from a Goldilocks including soft US dollar outcome in 2024. Overall to us, this suggests a more selective approach to Mag 7 allocation. Jonathan Stubbs joins us now for more. Jonathan, can you talk to us about the dispersion, maybe the fragmentation in that group of names that have dominated the equity market over much of the last 12 months?
Yeah, sure. I mean, it's been a sort of volatile journey for Mag 7. I mean, they're down 50% or so in 22. We sort of forget that. Super aggressive returns last year, and then this year, you know, on average, we're seeing very strong performance from Mag 7. You know, plus of 14% against the sort of SPX 493. The remainder plus 2% only. But within that Mag 7, we're already seeing that fragmentation. So 3 stocks are, you know, on average up about 40%. The other 4 are down to 4-5% on average. So that fragmentation's coming through. It's related to themes. AI, you've already mentioned who's attached to that AI theme. It's also related to earnings delivery. So earnings momentum's working, thematic's working, but that fragmentation's even happening within that Mag 7 group.
Jonathan, I love what you put in that earnings momentum strategy: sports, AI, and the metaverse. And that seems to really encapsulate what we've seen this year. So at this point, do you lean into that leadership, or do you start to say, now you need to normalize beyond the Magnificent Seven, especially because this dispersion suggests a bit of tiredness by some investors?
Yeah, that sort of sports AI metaverse conclusion came out of our work we did in December last year, where we looked at every single stock in the world, put them into thematic baskets, and then did a very sort of simple model looking at valuation, balance sheet, surplus free cash flow, earnings growth, earnings momentum, to see which themes had the best mix as a combination. AI, metaverse, and sports, which is sort of gaming, etc., were in those sort of top 7 themes, and they've performed pretty well this year. One of the snags here for the group and for the US market is that we've now got to what over the last 2-3 years have been sort of sell signals for investors. Firstly, valuation, secondly, technicals. Valuation, US market's back to around 21 times, 12 months forward. It's only been higher than this twice in 50 years when we've had liquidity bubbles in TMT and post-COVID. And then secondly, the technicals are pretty heavy right now. So if we follow the playbook of the last 2-3 years, we're probably sort of taking some risk off the table here, and we'd probably be taking some risk out of that Mag 7 and tech leadership group as well.
And putting them into European banks?
Well, European banks are interesting. They're clearly sort of not sort of long AI in the same way that some US sort of tech giants are, but they do trade on 6 times earnings and a sort of dividend yield of 6%. So you go from sort of one extreme to the other. There's very little priced into European banks. All they need to perform this year is to continue returning capital, which they're doing just as some of the big tech companies are in the US. And then you need the European economy to have a positive delta this year, an improvement out of the sort of the stagnation, technical recession we have right now. That's our view. So we think European banks do all right this year. And for balance, you probably want to be selective in US tech and also be selective in European banks if you're running a global portfolio.
Well, the bar is certainly pretty low for European growth in 2024. John, let's talk about leadership just a little bit more. The US tech, dominant NVIDIA, we know all of that stuff. We've got all-time highs in Germany, France, Japan in the last week or so. What does leadership look like in those countries, John?
Yeah, I mean, leadership the world over has been pretty narrow. It's been sort of pretty narrow in terms of size. That's a phenomena we're sort of seeing replicate in real economies, where we're seeing very strong commitment from government spending, supporting growth, but then the tail of the market, you look at sort of NFIB or you look at sort of small business sort of surveys around the world, they're suggesting we're in recessionary territory. So this bifurcation, this polarization in leadership and equity markets is also being reflected in the real economy. Over in Europe this year, rest of the world as well, the best factors year to date are strong balance sheets and price momentum. So investors are still running the same sort of trades that worked so well last year. And then balance sheet quality has become a big thing, which is sort of one eye on some of the very real and very sort of serious risks that we can all see around us, which are political and geopolitical in nature. So the market's sort of being sensible there, I think, and putting more weight on sort of balance sheet quality as an internal hedge to the portfolio. That's what's working so far this year. We would continue to run that balance sheet factor as we go through the rest of this year.
John, it's interesting you suggest that you can take that hedge within the equity market, not from another asset class. Is that the approach you're hearing from a lot of investors as you hit the road and speak to clients?
Well, two things. If you run sort of blank sheet of paper, sort of full asset class, then my own sort of asset allocation framework has a 25% weight on what I call my world hedge or my liquidity hedge, 25% weight on a combination of cash, gold, and Bitcoin. That's a high sort of hedge, but I think is appropriate at this point in time. And it's a mix of assets which are meant to not be correlated with risk assets themselves. If you can only sort of invest in the equity market, we've got some strategies for that. One of that is a systematic strategy that runs buyback momentum and then overlays various factors like quality and valuation. What that buyback strategy does, it gets you into the companies which are in the habit and are likely to continue buying back shares, which gives you liquidity support and a growth advantage. So I want to be long liquidity, I want to be long growth, and running a systematic buyback strategy, both in the US and Europe, I think is pretty sensible. We write reports on that and send screens to clients on that basis.
So the hedge is cash, gold, and Bitcoin. There's one glaring absence there, which is government bonds. Is this the new era where 60-40 doesn't work and that no longer is a diversifier?
Yeah, I mean, I read about that first 3 years ago. I said 60-40 is inappropriate in this sort of post-financial crisis, post-COVID world where inflation is something which investors have to consider much more seriously. I've been there, I'm still there, and my asset allocation framework reflects that. One interesting sort of aspect is that the US equity market has added $30 trillion of market cap since end 07, 30 trillion. That is exactly the same net increase in US monetary and fiscal support since then. So if you add up the central bank balance sheet expansion of the Fed, you add on the sort of the increase in debt, you've seen a $30 trillion delta. That's exactly the same increase of the US equity market in terms of market cap terms over that period. What happens next is a mixture of how much more support we get coming through the US channel. Debt, as we know, is heading aggressively higher in terms of multi-trillions of dollars, and the impact of that on the US risk premium, on the dollar, on interest rates, and also on the ability of the US economy to generate reasonable growth. So that's where the debate is. But yeah, 60-40 for me is done. We have to be much more active, much more nimble, and currently I'm carrying a pretty sort of heavy hedge against various sort of event risk around the world.
Just quick, Jonathan, you were talking about how AI and metaverse has really controlled the narrative recently in tech. Does Apple now qualify for that bucket now that they've gotten out of their car excursion?
So the way we do this is, we look at companies with their existing exposures rather than their future exposures. Obviously, certain companies can accelerate the shift from not having exposure to having exposure via sort of corporate actions and the like. So when we run our thematic screens, it's on existing business exposures. So those companies that have high sort of AI exposures live will be in those baskets, and that's what we sort of calculate our analysis on.
I remember a few years ago when having an EV plan was bullish, and now not having one is bullish. Have you noticed how that's changed in a couple of years?
I remember, I'm old enough to remember when they put Bitcoin in the release and Overstock rallied something insanely. So, or they talked about the different chains of command and the way that they're going to use blockchain, and that was it. It was Overstock was a Bitcoin stock.
Jonathan, I want to squeeze in one further question if I can. Look at the performance over the last 12 months. You talked about the performance over the last 16 years. I just want to go with the last 12 months. Nvidia up by more than 200%. Microsoft with a gain of something like 63, 64% higher. John, for the people who have missed this equity rally, who were told over the last 2 months that this market was priced for perfection and then it carried on rallying, what are you telling those people to do now?
Yeah, it's a very sort of important question because we see many investors who may have had 3 or 4 of the Mag 7 stocks last year, but that wasn't enough. If you didn't have all 7 and you're sort of benchmarking against the market, you're sort of you're behind the curve from the get-go. So there's a very real challenge there for investors. That is why I think there's a lot of catch-up, a lot of price momentum strategies which are continuing to win. We think you've got to take a step back at this point, look at valuation, look at market risks, and run real-time today and everyday strategies that make sense. When we do that, when we combine sort of earnings momentum and when we cover with quality and valuation factors, we get some Mag 7 stocks. We don't get all of them, and we get stocks from the rest of the market. So we think that that balanced approach to investing real-time today, given the risks out there, is much better than closing your eyes and just buying these 7 companies.
Interesting. Thoughtful stuff, John. Always is. Thank you, sir. Jonathan Stubbs there of Berenberg. Equities right now negative by 1/3% on the S&P. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Deutsche Bank staff are pushing back after bosses told them to come back into the office more often. The bank told staff 2 weeks ago that they had to be in at least 3 days a week. That would start in June. The policy had allowed for many employees to work from home as much as 60% of the time. CEO Christian Saving and COO Rebecca Short are now planning renewed talks with labor representatives. Lawyers for FTX co-founder Sam Bankman-Fried have proposed that he serve no more than 6.5 years in prison and pay no financial penalty for the fraud that brought down the crypto exchange. Bankman-Fried is facing a sentence as long as 20 years for the most serious charges. A court filing cites Bankman-Fried's charitable work and letters from psychiatrists, including an autism expert. Prosecutors have until March 15th to respond before his March 28th sentencing. A series of wildfires have ravaged the Texas Panhandle. Governor Greg Abbott has issued a disaster declaration for 60 counties. Residents have been ordered to evacuate or shelter in place, and a nuclear weapons facility has been forced to shut down. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, making progress in Washington.
We believe that we can get to agreement on these issues and prevent a government shutdown, and that's our first responsibility.
Productive meeting on the government shutdown. We are making good progress.
They're making good progress, apparently. That conversation's up next. Live from New York City this morning. Good morning.
multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I don't want my daughters wasting time thinking about how much they weigh, what they look like, and I think that fashion has done a terrible job of reinforcing a really unrealistic beauty ideal. And so with Good American, the whole premise of the brand was to say, we're going to make clothes for all women.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, equities pulling back 1/3 on the S&P. Bond yield to look like this. Yield to lower by a single basis point, 428.75. Under surveillance this morning, progress in Washington.
We're very optimistic. I hope that the other leaders came out here and told you the same. We believe that we can get to agreement on these issues and prevent a government shutdown, and that's our first responsibility.
It was both a productive and an intense meeting. Productive meeting on the government shutdown. We are making good progress.
Here's the latest. Speaker Mike Johnson willing to kick the can down the road, pushing government funding deadlines to March 8th and March 22nd. That according to Punchbowl News. Congressional leaders expressing optimism a shutdown will be avoided after yesterday's White House meeting with President Joe Biden. However, lawmakers remaining far apart when it comes to international aid and border talks. Kim Wallace, head of Washington Policy Research at 22V Research, joins us now for more. Kim, tell me why you believe we can avoid that government shutdown.
Well, because it's in the interest of the vast majority of members of Congress. It's very straightforward, John. Shutdowns are not a good campaign theme.
When it comes to moving the dates for the shutdowns, Punchbowl News is saying that Johnson is only willing to do it if he has an agreement with Democrats on those 4 bills. Do you see an agreement before Friday?
That's difficult, Anne-Marie, but it's possible. The appropriators have been working on the routine FY24 spending bills for the better part of 3 months. They know each other very well. They would prefer to pass all 12 of these bills and do it behind scenes and not with the drama. So my guess is that if they're given another week or two, they'll be able to get it done. So the issue will be, of course, the codicils, the so-called riders, the public statements of politics.
Yeah, what are the Republicans willing to give up when it comes to the policy riders?
You know, nothing until the very end. So both sides are starting from the absolutes, right? Democrats don't want any codicils or riders. Republicans have a long list of them. Behind the scenes, there's another force that people aren't talking enough about. There are about $7 billion of earmarks for members of Congress. Almost 100 members of the 535 of them don't have an earmark at stake. So my guess is they'll be able to figure out the appropriations, avoid shutdowns, get the earmarks, and go campaign.
To John's point, bringing you in, the issue now becomes foreign aid and the border. President Biden and former President Trump are both due at the southern border tomorrow. Do you think Biden is going to have to make some sort of executive action when it comes to shoring up migration?
It's possible, Anne-Marie, but it's not effective. Executive action is not what's needed for border policy, both northern but particularly southern border policy in the U.S. We've got a multi-decade iterative process that has resulted in a dysfunctional system. Doesn't work for many people, especially U.S. citizens. We have a lot of folks in our country who shouldn't be here, not tracked largely because of ineffectual immigration policies over decades, not the last 2 or 3 years.
Do you think that Speaker Mike Johnson is regretting being in that role?
Lisa, if he's not, he soon will be. My sense is he's had some remorse. You know, it's not a bad gig. You get a plane, but he's in a pressure cooker every day with no easy answers on anything. And then he's got the outside force of a presidential candidate attempting to steer his legislative agenda, usually against the interests of most members. From a strategic standpoint, Donald Trump is not known to think in other people's interest, and that's showing up in his legislative advice. I think immigration is a great example. Public opinion shows that it's now the #1 topic. They've achieved that goal. but they had a bill, a comprehensive bill, bipartisan from the Senate, that they've turned down because former President Trump did not want them to bring it up. It's a tough place to be in. They're going to have to figure it out, but it'll have to be legislation. If we move on immigration policy in the U.S., it's only through legislation.
What's interesting to me is that you're seeing, even though you talk about the former President Trump and how he kind of goes ahead regardless of dissent among other Republicans, you've seen people get in line much more than they did, say, 6 years ago or 8 years ago. And you hear even Mitch McConnell kind of deferring or walking away from being too critical of the former president. How much do you think that they are actually taking their cues, to John's point earlier, from Donald Trump versus trying to kind of go rogue just quietly?
It's a mix of both, but clearly over the last 8 years, Donald Trump has been a strong influence in the Republican base, or people who line up and vote for Republicans. Most members of Congress who caucus in Republican circles can't afford to write off that base. And so they have a very difficult balancing game politically. In fact, some of them absolutely agree with the president on most of his policies. So it's a mix of necessity and a mix of politics, but that gets a majority of Republicans in the House and the Senate not wanting to upset the former president.
Speaking of a difficult balancing game, can you tell us what you thought of the results of Michigan for President Biden?
Oh, I think the uncommitted side sent a very strong message to the president about his policies in the Middle East. There's no question of that. But at the same time, he came out the victor. This conversation is going to be an element in the election until we no longer have a war in that region, or we no longer have an election, a presidential election in front of us. I think the addition of CIA Director Burns at the top of the meeting among leaders yesterday gives you a strong sense of how serious the White House is about aid to Ukraine.
Hey, Kim, great to catch up with you, sir. Appreciate it. Kim Wallace there of 22V Research on a range of topics. Let's pick up on that last one just for a moment. Michigan, what you can take away from that feels like a protest vote in a primary. Does it actually translate to difficulties at the national level in 9 months' time?
Well, that's the question. Can Biden make sure that these individuals actually come out and vote? They're not going to go vote for Trump, but they could stay home. And when you're looking at such slim margins in a swing state like Michigan, it just goes to show they made a huge pushing, as Kim was saying, to bring across their protests. Now the campaign needs to meet them and explain what they're going to do. And I think it's why Biden said that in New York, when he was in New York yesterday. I think it's why he made that comment to the press saying maybe Monday we'll get a deal on a ceasefire.
While eating ice cream. But there is this question also about how much this really speaks to a younger crowd too, and dissatisfaction with the election overall, and who's going to stay home among a younger generation, because a lot of polls really point to a disenfranchising kind of feeling among that population.
Isn't that why he was eating ice cream?
Because
to try
it appeals
and talk
to them.
to the younger audience.
Okay.
The president likes ice cream too.
Ice cream and chocolate cookies. Look, I think that, again, the handlers need to get a hand on the message
He needs
and
to watch
what's
his
going to resonate.
glucose intake. We haven't talked about former President Donald Trump's showing, though, in Michigan too much yet. I just want to bring up one point. Trump came in at 68.2%, Haley 26.5%. There's also a caucus in Michigan on Saturday that will shore up the rest of the delegates. We know he's going to be the nominee. But Iowa, Trump 51%, New Hampshire 54%, South Carolina 59%. He hasn't broke 70%. And he's running as a quasi-incumbent. It also shows that he has general election issues.
Transition from glucose intake to the former president. Just
maybe he should watch his glucose too. He's also known to like fast food.
Great
so one likes
transition
desserts, one likes fast
How about
food.
this transition? Can you please explain to me? It was 61 degrees yesterday in Washington, D.C. Why did they have a roaring fire in a room where they're all wearing suits?
Well, you go to the Oval Office, you got to dress up. I didn't check out Hakeem Jeffrey's shoes, that, remember, he's the one that started that controversy with the sneaker loafers.
Don't get me going with the shoes. Don't get me
I know
going
Bill
with the
Burns
shoes.
definitely wore
Shoes,
nice dress shoes.
ice cream. Up next, real news. Apple putting the brakes on its decade-long effort to build an electric car. New Street's Pierre Ferragut joins us next.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities down 1/3% on the S&P 500, down by 0.4 on the Nasdaq, underperformance on the Russell, the small caps negative 0.7. It's catch up already, not even 2 months into the year. And we've had upgrades from Barclays, Piper, UBS, and Goldman. We'll be talking about those calls a little bit later in the program. The stock market higher this month by something like 5%, up by 6.5% so far in 2024. They told us we were priced for perfection. What are we priced for now? In the bond market, the 2-year, 10-year, 30-year shaping up as follows. A 2-year yield of 467.67. Yields down about a basis point or two. Down 2 basis points on a 10-year, 428.36. Lisa, we had a ton of supply come out of the Treasury this week. Look, it wasn't stellar, it wasn't amazing, but it was all right.
Yeah, and yesterday actually came out better than the 2-year and the 5-year auctions. The 7-year auction came out better than expected. That said, there's been a real repricing here, and I think it's important to note that now the market's kind of come to the Fed's view of only 3 rate cuts this year. You're seeing inflation expectations creep up over the next couple of years. But what I keep wondering, and Katie Kaminsky, I'm so excited to hear her come later in the program, she's saying bonds are sending a completely different message than stocks. I'm curious about that.
Is the short signal building in the Treasury market? Katie coming up a little bit later. Let's finish on this in foreign exchange. Bramo, I want to talk about one currency pair, and it's the Kiwi against the US dollar.
Yes.
Who does this sound like? Core inflation and most measures of inflation expectations have declined, and the risk to the inflation outlook have become more balanced. That's like the Federal Reserve 3 months ago. That's the Reserve Bank monetary policy over in New Zealand. That's a weaker Kiwi.
The Kiwi had been outperforming because they actually, some people were expecting maybe even a hike at this meeting. This was expected to be a hawkish meeting, even with a 5.5% benchmark rate over in New Zealand. The fact that they came out with basically a dovish to expectations message tells you maybe we have entered this easing cycle that is going to have to reverse or
They're done hiking at least.
Yeah, exactly.
They're
But that's
done
new.
hiking.
That's new.
I agree.
Go
That's
Kiwi.
the latest. That's the excitement of foreign exchange for you. That's a slightly stronger dollar against the bulk of G10 this morning. Much stronger dollar against the Kiwi. Under surveillance this morning, President Joe Biden and Donald Trump cruising to victory in their party's primaries in Michigan. Former President Trump continuing to sweep primary and caucus contests ahead of Super Tuesday next week. President Biden facing opposition from his party in the swing state. Over 13% of voters were so-called uncommitted. Many of those votes cast in protest of Biden's handling of the Israel-Hamas war. Michigan is one of the highest representations of Arab Americans in the country. MH, if this is going to translate to the national stage, the president's got a problem.
Yeah, and he has a lot more work to do in Michigan. And we've also seen some in our polling, actually not just Arab Americans and Gen Z. Also, this is more prolific beyond Muslim Americans in terms of his handling of Israel and Hamas. But Michigan also, we do see Biden lose votes with some rank and file when it comes to the union. So the campaign really needs to get out in Michigan. 2016, Trump won it. Biden was able to win it in 2020. These small voting blocks are critical when you're looking at swing states.
Can we talk about the former President Donald Trump as well? He had a big influence on the fate of that border agreement that didn't happen down in Washington, D.C. Just trying to figure out how much influence he has over the speaker on the current issues we're talking about, aid to Ukraine aid to Israel, the potential for a government shutdown. How much influence does he have there?
I think he has a lot of influence because he has a lot of influence with the hard right flank of the Republican Party and those members of Congress. And those individuals have a tremendous amount of influence on whether Speaker Johnson keeps his job or not. So that's where the influence is. But I think for Trump, the bigger issue was the border. Now it's become top of mind of American voters, right there with the economy. The latest Monmouth University poll is putting it about 6 or 7 out of 10 voters say this is one of their #1 issues. And both him and Biden are going to the border tomorrow. So he's got what he wanted out of Congress for the moment, and I think that was to make immigration the top issue.
That skinny margin in the House got skinnier over the last couple of weeks. Let's talk about policy, state to state. Jamie Dimon praising Texas for its business-friendly policies, citing the lack of an income tax and light regulatory touch. After touring a worker training facility in Houston, the JP Morgan CEO also criticizing some New York elected officials as being anti-business. He said they were the reason Amazon chose not to build a second headquarters here. JP Morgan's workforce in Texas has surpassed 30,000 in recent years. New York's total has slipped to less than 29K. So I don't think this was a jab at the governor, or the mayor for that matter. This sounded like it was directed to AOC. And based on what he said, Bramo, I think a lot of people might agree with him.
Yeah, well, and I think a lot of businesses are moving with their feet. Maybe not as much as some people thought when it came to the pandemic, but still you're seeing on the margins. The fact that you have now more employees for JP Morgan in Texas than in New York tells you a lot. What I'm wondering is how much are they really, is this something that's addressable with respect to tax rates and respect to certain policies at a time where there's a cost structure that is unsustainable at the moment, and there is a deficit certainly in New York?
They are one of, if not the biggest private employer in Manhattan. And what's amazing, I heard a story a long, long time ago about how the former mayor, de Blasio, never met with some of these CEOs of these financial institutions. Being anti-business, Bramo, it was a badge of honor for the Democrats and for some of the people running the city over the last few weeks. It's just absolutely remarkable considering what we're coming out of in the pandemic and trying to get people to come back into the city to work.
Yeah, but it goes to this whole conversation of anger cells. And a lot of people see wealthy people and then the division with poor people, and they say wealthy people need to pay their share. That's been sort of the message of the progressive flank. And what's interesting to me is how the progressive flank and the hard right flank are converging in certain capacities, not necessarily with respect to taxes, but with respect to certain business policies, including tariffs and other types of things. So it's really a jumble right now as we really face off with a very different political sphere.
But when you look at New York, this mayor, Eric Adams, is courting the business community. I've spoken to him about this. He wants all of the high rises filled. He wants everyone back to work. And he says this is a huge issue because it's not just people getting back to work using the MTA, using the subways and the buses, for those that do use the subway and buses like Lisa and I, but also to make sure that those shops are visited, people going to lunches, et cetera. When you look down some of these avenues in New York, you still have real estate that's empty.
Oh, take Lexington Avenue, all the way down to Grand Central. The hotels that are shut and just never reopened. I know parts of the city are doing well. Midtown West is kind of built up. A lot of banks moved over there. You drive down there or walk, you'll find out things are pretty busy. But Lexington Avenue and other places, Bramo, it's been a problem. And I'd say this problem actually predates the pandemic in many places. Those blocks that are like boarded up and there's no stores there, it's been a problem for a while.
Yeah, and basically what you have, I mean, across the street from us, the entire front of all of the buildings is completely empty in the storefront level. This is a more structural shift, though, also, with respect to real estate owners and what they're willing to recognize in some of their statements as either tax losses or what rent they're able to actually charge.
Let's turn to Apple. Final one for you. Apple is ending a decade-long effort to make an electric vehicle, looking to make ground in the race for AI. According to Bloomberg, executives told nearly 2,000 employees working on the project that they will now be shifted to an AI division. Generative AI is a growing priority as Microsoft, Meta, and Alphabet all compete to lead the industry. Pierre Faragut of New Street Research covers Apple with a neutral rating and a $175 price target. Pierre, I'm pleased to say, joins us right now. Pierre, first question for you, sir. What was the message that Cupertino, California sent to Detroit, Michigan just yesterday?
Good question, John. I guess it's like good luck, guys, right? It's Apple has tried very hard and they came to the conclusion they can't make like a sustainable and good business at doing cars. So does that mean Apple is not good at doing stuff, or does that mean doing cars and competing in the marketplace today is very tough? I think the latter makes sense. My analysis of the situation is Tesla has been doing an extremely good job, has pushed like the bar very high, and now the Chinese are coming in. filling the void around Tesla, and the competitive gain between Tesla and the Chinese is not going to leave much room for others to be successful, even if you're Apple.
What do you think this is going to be in the future, Pierre? Just work with me here. Is this going to ultimately end up being, and do we ultimately descend into some kind of quasi-state-sponsored national winners from region to region in America, in Europe, in China, because we don't want to compete with each other because we know what the fate of the auto industry will be if we do?
Yeah, I think if you look back at the history of the car industry, the answer is sitting right there, and you're spot on. The car industry has already been subsidized for several decades by regional forces creating regional clusters. The reason for that is simply that it's a big industry. It's a lot of workforce, a lot of employment, a lot of local employments, and the governments in the West have been protecting car manufacturers from the Japanese, like almost 40 years ago, and so I think it's going to continue for sure. So the way I see the future of the industry, you know where I come from, John. I used to cover like smartphone manufacturers. You'll have Tesla competing with like the best Chinese players, BYD, and it's going to be very hard to make a living outside of these two poles in the industry. And I think, yes, I don't think traditional manufacturers are going to disappear. They're going to be supported by local political forces to survive.
John pointed out that the initial response in Apple shares after this news came out was a rally because people were maybe relieved that they were moving on from something that never seemed to come to the fore. How do you think about this? Does this make you more optimistic about Apple's valuation going forward as they start to offset some of the fears about the lack of AI discussion and invest more there?
Yeah, there is an element of positive surprise, positive news here with Apple. So yes, it means Apple is never going to make money doing cars and participate like in the $2 trillion market. But nobody was like super convinced that Apple could do such a great job there. Like the positive news here is Apple has not lost their mojo. They either do things perfect or they don't do them. And I think like they are like formally giving up on cars means Apple still has this culture embedded, and I see that as a very positive. Now, is that a positive for the stock? Is that changing my view on the stock? Not really, because as a project, the car initiative was just a drop in the ocean in terms of cost, in terms of like capital invested or resources invested and risks taken, because Apple is a very large business. So a positive signal about what Apple is, like a great company doing great products. Does that mean Apple is suddenly going to break away from where they are today, which is like a very mature franchise where it's difficult to find additional growth drivers? Probably not. What's going to grow revenues at Apple in the next 5 years beyond their service business? Is that going to be the Vision Pro? It's still like a very, very, very long shot. Is that going to be a car? Definitely not. So we're still facing a situation where Apple is not a high growth business, and valuation is a bit of a challenge in these circumstances.
We talk about AI as though it were a monolith, and I'm guilty of this, and it's not. Who would Apple be most directly competing with in their AI effort? Would it be a Google? Would it be a Meta?
So Apple is, like everybody else, looking at generative AI, changing what they do more than anything else. So when they do AI, they have to, yes, offer like a fantastic value proposition to users on their devices, and they need to do that to make sure they don't lose their opportunity to their traditional players who also take a share in like the product value that you have around consumers, including internet, like advertising revenues and direct revenues. So it's not really shifting Apple in terms of where they're going to compete. They're going to continue to compete against Apple. And yes, if they don't do anything on generative AI, and Google does amazing things with their, the Pixel phone becoming an amazing phone thanks to generative AI, and the iPhone stays behind, then Apple is at risk. So that's exactly where they're competing, yes. And they need to invest a lot of money, like everybody else, because we don't know what generative AI is going to deliver. As Tam said, what generative AI is going to be is still behind the veil of ignorance. We we don't know what the next models are going to do. So you have to go into that race and invest a lot and make sure that when AI starts really changing our user experience, Apple is not out of the game, because if they are not, they're going to have to compete against everybody. Everybody is going to be able to eat their lunch.
Pierre, how much damage do you think Google has done recently with their Gemini image failures?
It's a good question. It's hard to say. It feels like it's a lot, because ChatGPT created like a surprise, a wow effect 18 months ago. 3 months ago, Google managed to come back and announce with a lot of noise their Gemini model, like pitched like very advanced features, and now the model is really like, you know, creating very, very bad vibes. So it doesn't make people feel like Google is on top of that technology, and they've not demonstrated they have an organization that is able to bring to market like this very, very large, very complex model in a way that is more or less controlled. So I don't know if consumers really care about it at that stage, but you know, if everybody is using Google search today, it's because that's the best search engine, but it's also because that was the first engine to be available at that level of performance in the market very early on, and it took years and years for alternatives to be able to be in the marketplace. And so the big risk for Google is that while they're still trying to figure out how do you bring to the market a product like Gemini without, you know, it's a question of balance, striking the right balance between the model not being what it is today, like afraid of showing like a white historic figure white, and but still being very careful not to create a harmful content. While they're struggling with that, the risk is that OpenAI and Microsoft keep making progress.
Bad vibes is certainly one way of putting it. Pierre, wonderful to get your thoughts on the Apple story as well. Pierre Farragut there of New Street. The stock, Apple, is slightly positive this morning. Google, Alphabet, negative by 0.5%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. United Health is reportedly facing an antitrust probe by the U.S. DOJ. Sources say the probe is over their acquisition of healthcare providers and data companies. United Health is the largest U.S. health insurer. Both them and the Justice Department declined to comment. eBay shares are up in the pre-market. It posted strong results for the holiday quarter. It also added $2 billion to its stock buyback program. Fourth quarter profit was $1.07 a share. That is beating analyst estimates. The company has also been losing market share to Amazon and Walmart. Last month, it announced 1,000 job cuts. Beyond Meat surging in the pre-market, up 55%. Fourth quarter sales beat expectations, both internationally and here in the U.S. CEO Ethan Brown said the company will work towards profitability in 2024, doing things like reducing operating expenses, adjusting prices, and releasing a new, healthier Beyond Burger. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, markets falling in line with the Fed's view.
A market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1 before the end of the year.
What a change in just 2 months. Live from New York with equity futures just off session lows. We're down 1/3 of 1%. This is Bloomberg.